Zeke. So good morning, everybody, and or good afternoon. For most people, it's probably afternoon. I'm in Southern California. So for me, it's still 10 a.m. in the morning. Today, we're going to conduct a forum on the topic of CBDCs. What prompted this was my reading of the Fed's CBDC discussion papers and consequent request for comments, which I started answering and consequently got very confused about, wrote a little article that I shared with most people on this call here and seek feedback to be better positioned, understand what the directive here should be and is currently. A little bit of background on who we are, what we do, and for full disclosure, what we're going to discuss here has only peripherally to do with what we do at the fund here at Sustany. We invest in disruptive financial solutions, hence the interest in central bank digital currencies. We looked at about 1,000 solutions over the past 4 years, and we're currently working on a book that's titled Streaming Money as a Fund. We take a very scientific approach to the topic of technology investing, which means we write our own thesis papers, share these for peer review, and we look at every startup as an experiment on these ideas. So after doing this for quite some time, we got quite a few peer reviews. We started sharing this with academia, so you'll notice on my profile that we are responsible for some curriculum design. So if that's something that you're interested in, we'll like to help out in this respect. So reach out to me after the event. But again, this is not about me. There's a lot more qualified people on this call. And we're going to start initially with the piece of policy. That's probably the thing that I understand least. Technology, I understand a lot. Legal parts, I understand a little bit. Having been a lawyer a long time ago. But with that said, so everybody who is on the policy panel, please turn on your mics, turn on your video, and we're gonna keep this pretty rapidly moving here. Hey, Norbert. Hey, Zeke.
Hey, Chris.
So, hey, Les. So rather than me trying to attempt to describe what you all are doing, so I'll give everybody of you 90 seconds to just introduce yourself, and then we're just going to start with some general questions. And if anybody in the audience has questions, please direct them to either Mike or Jeff on the call, and they will funnel them through me or just ask them direct. And to anybody who hasn't read the paper that we wrote about this topic, it's linked in the event registration page. That might be helpful as context. At the end, it has the questions that the Federal Reserve posed and that we're going to discuss. So Norbert, do you want to tell us what you do?
Yes, hi. I am the Vice President and Director at the Cato Institute's Center for Monetary and Financial Alternatives. And we cover policy issues relating to bank and securities regulation, all financial markets, as well as monetary policy.
Zeke.
Sure. Hey, everyone. So my name is Ezekiel, or Zeke for short. I work for a company called C Labs, which built the mobile first blockchain layer one called Celo. But in my previous life, I worked for the Federal Reserve Bank in New York. So now I spend a lot of my time thinking about CBDC architectures, stablecoin technology, policy as it relates to CBDC, monetary policy, et cetera. So thanks for having me on.
Excellent. So yeah, as I mentioned, so on policy parts, I'm probably the weakest. We have some engagement with regulators and so forth that we're trying to educate in the ways that we look at the space. But maybe, Norbert, you can start there and maybe give us just some fundamentals. What are Fed policies about, really?
Sure. Thank you for having me. And for me, this is at the core, this is a public good issue. And what the policy is really about here is whether money is or is not a public good, whether payment systems are or not a public good. And I can just run through a couple things. And if I'm going too long, just tell me to stop and I'll,
No,
okay.
That's
right.
terrific, yeah.
Okay, but I'm not planning on going very long. So, so the first thing that I just want to point out is when you read the Fed's report, I know as many people in here probably have, you see, as you will see in many other central bank digital currency reports, a great deal of ambiguity. There's very little attention to detail, and those details usually really do matter. It makes having a discussion about these sorts of issues that are well, about CBDCs a little bit tricky, almost as if I'm using a straw man technique. And I don't want to do that, but I can't address everything that they say because they don't really say it in a careful way. So I'm trying to piece together all of that. So, for example, they pay very little attention to the difference between a payment system and money. They essentially treat them as the same thing and as a public good. And and neither is true. They also frequently talk about China's efforts to create a central bank digital currency as if that alone will put pressure on people to stop using US dollars, as if the Chinese CBDC will represent a new payments network. And what they neglect to tell you is that China already created an alternative digital payments network. So they already have an alternative to chips or SWIFT, the CIP. They don't need a central bank digital currency to do that. And by focusing on the CBDC, you obscure a lot of the debate that we should be having, which is that there are legitimate criticisms of chips and SWIFT and FedWire. All of those existing payment networks, which are digital, are heavily regulated, and the Fed gets a lot of the blame for the inefficiencies in those networks. The inefficiencies have nothing to do with whether dollars can be transferred electronically. They are. What they have to do with instead are things like FedWire doesn't operate 24 hours, 7 days a week. That's very easy to fix.
Yeah.
There's no new technology for that.
But and there actually, I was wondering about that because while I was reading the paper, I was actually like specifically looking for the word public good and I couldn't find it because that would be my starting point, right? If we defer the right to the government to create currency, then that comes with certain obligation, at least in my mind, right?
That's right. And one of the interesting things as all of this has unfolded over the last few years is, I don't know if how many people on here were involved with the Facebook folks when they first came out with their Libra initiative. Those guys were running all around talking about how money is a public good, and they didn't want to upset that. And I and several other people I know in DC kept saying, hey, wait a minute, don't say that. but they were. So for whatever that's worth, that is definitely at the core of this, but they don't want to say that. And that's what I want to touch on that. And this is why I think that what's in that paper, the Fed paper, should be scariness. They should scare us a lot. They should be strengthening Congress's resolve to stop what is going on. Although I'm pretty sure there are a lot of people in Congress who are pushing this, but you can see it in the way the Fed defines a CBDC in that paper. And they do that as a digital liability of the Federal Reserve, one that's widely available to the general public, but that's not the key part of that definition. And that the key part is the digital liability of the Fed. To force that form of the dollar on everybody is a huge difference from what we have today. And the paper explicitly acknowledges this difference, and it states that money would no longer be a liability of a commercial bank. It would be a public good. They're not saying it, but that's what it would be. And that's incredibly important when the advocates of this talk about the main benefit, or a main benefit of the CBDC, which is always financial inclusion. And no matter what they tell you, what they're leaving out is that people are not frozen out of the financial system because the dollar can't be digitized. That's not true. They can go to Walmart. Anybody can go to Walmart and get a prepaid card. Dollars are digital all over the place. What the FDIC surveys demonstrate is that whatever extent people don't use traditional banks, it's a two-part problem. It is a broader socioeconomic problem. They don't have enough money. And it's a regulatory problem. They don't want to give over all the AML information. And what's obvious is that the solution that the Fed's talking about and advocates of a CBDC are talking about is converting money to a public good and then giving it to people, giving people these new digital dollars. No matter how you slice it, that is ultimately a fiscal transfer. And it's no different in terms of the economic effects than just Congress passing a law giving people prepaid cards with money on them.
Let me extend
if
this.
Congress wants to do that, they can.
No, let me extend this to Zeke, because Zeke actually was liaison to the Treasury while he was at the Federal Reserve in New York some years ago. So he can probably bring some good insights to what he thinks the Fed is up to here.
Sure, thanks. And let me just start off by apologizing. I'm having solar panels installed at my house, and there might be some loud background noise, so I'm hoping it won't be too bad. But yeah, so I mean, I guess, as a former central banker, I am sympathetic to what they are doing, and I think that we need to, I think we all recognize that CBDCs and digital currencies, whether they're stable coins, are it's a tremendously complex problem. And I think that one of the things we don't appreciate perhaps is the fact that, the Fed, like all of us, are trying to understand this technology, trying to understand how this affects not only our current financial system, but the global system, the global financial system. Unfortunately, they don't have the luxury of thinking out loud. I didn't expect anything from this paper, because if you look at the way central bankers talk, they want to preserve optionality. They want to make sure that they're not getting cornered. And I think we can also recognize that financial markets, for better or worse, place way too much emphasis on every single syllable and word the Fed says, and what that could potentially mean. I read this and I start thinking about, what happened in May of 2013. And for all of you who were in the financial markets, that was during the taper tantrum, right? And Bernanke said something, pretty sort of banal, in my opinion, was that eventually the Fed will have to taper, right? And it was a pretty common sense thing, but the markets just freaked out. And the Fed doesn't want to impact financial markets in that way, right? They don't want to have sort of unexpected impacts. And so when you look at this paper, they didn't say anything that hasn't been written about CBDCs in a dozen to 100 other papers by the IMF or the BIS or anything like that. I think the idea, you mentioned this idea of the CBDC being a liability of the Fed. And to be honest, that's exactly the definition of a CBDC, right? I mean, it can't be a central bank digital currency if it's not a liability of the Federal Reserve. Now, if that scares people, then they need to then stop thinking about CBDCs and thinking about something else. I mean, I think that we can't blame the Fed for saying that, they're talking about a CBDC as a liability of the Fed, when in fact, that's the very definition. You do raise some good points, Norbert, about, the unbanked. And I think that, one of the issues, that I do have with this is, they want to keep a two-tiered system, whereby the Fed would issue CBDC, but then they would leave it up to the current traditional banking system to essentially do the distribution part of it, right? So they would leave it up to the commercial banks to do the onboarding for customers, doing the KYC, AML. Like I understand that, and I'm certainly sympathetic to why they would want to do that, for reasons of bank disintermediation and financial stability. But it doesn't really address the issue of for financial inclusion, for example. It doesn't really address the issue of like, if people aren't using banks now, why would they suddenly go to a bank tomorrow to get a Fed issued CBDC? So I think that's something that the system has to sort of recognize. But again, like I look at this as a way for the Fed to start to solicit the conversation. They're having far more complex and meaningful discussions that they're not going to talk about with anybody here, including me. They understand this stuff far better than they're letting on, because frankly, I'm sure they recognize that digital currencies are the wave of the future, whether that's stablecoin technology or a CBDC. I also think the Fed has the luxury a little bit of the fact that right now, all the stable coins almost all of them, I think 99.9% of all stable coins are denominated in US dollars. So they still have that impact when it comes, right? They're not giving up their monetary, authority on the dollar, because everyone is still using dollar-based instruments. But I think if you were a central bank in a small emerging economy, you would certainly be quite worried, and you would be quite interested in creating CBDCs, because, you don't want your citizens to all of a sudden be using dollars, right? And all of a sudden then your economy is being dollarized, and that has some significant impacts. But like, I don't think that we should be expecting the Fed to lay out all their cards as to what they're thinking in these papers. They're asking people their thoughts. I think it's great that we're all talking about it, and hopefully we can continue to have a meaningful conversation. But this is a tremendously complex issue. The Fed is certainly worried about their reputational risk, and I think it certainly goes to show we're all sitting here talking about trying to parse the words of the Fed already. And this is a topic we're going to be talking about for years, because it's not something that's going to be solved today. It's more like 5 to 7 years down the road.
We as technology investors, we obviously have a very particular view on these topics, right? So we always look at this from what is the total addressable market for a new technology. And so we ask ourselves just very principled questions, i.e., what are the current problems that people experience in respect to government-issued fiat currencies? And we can, I think, generalize this to some extent for the currency that specifically the United States Federal Reserve issues, because almost half of what they're printing is actually going overseas. So point there being is that for a lot of people around the world, they have two issues. The main issue is, somewhat surprisingly for people that live in the United States, the topic of surveillance. So i.e., if I'm a citizen of an authoritarian country, then I may or may not be able to use the local financial system, because it's putting me in danger, because I might be receiving funds from somewhere that the government frowns about or there's capital controls in place that don't let me do certain things. And then the other thing that everybody is experiencing is simply that of debasement. And so that's why I'm consistently surprised with all of these discussions that none of those 2 points are being addressed first. So, Norbert, is this like very deliberate? Is this just like a straw man? How do you view that?
Well, I think much like Zeke is saying, they have lots of different pieces of this, and they're trying to deal with not only whatever they're going to, have whatever feedback they're going to receive from the public, but they have to deal with Congress. And to be clear, I don't blame the Fed. The Fed's doing what the Fed should be doing. And this is ultimately an issue that they're going to have to be engaged with Congress on. And it is going to be political. It's probably going to get messy. And I think that when you talk about cross-border payments, you get a lot of the security issues that pop up. That's almost another can of worms by itself. Not that I necessarily am arguing that that's the way it should be, but I think that does happen. So I don't think that there's anything nefarious going on. I think they're trying to do the best that they can, the Fed, to set up a conversation based on the main issues that they're facing. And I think that they do a good job of talking about the issue, and trying not to take a firm stand on it. Even the cross-border payment issue.
Yeah, I mean, I would say, and I think the issue of privacy is an incredibly, important, but also complex and difficult one. I don't know that there's any, I mean, I think the Fed certainly understands that if they're trying to create a CBDC that behaves and acts like cash, obviously people hold and use cash primarily for these ideas of privacy and censorship resistant and all of that. I certainly think that they would like to see that. I haven't seen really any of that in the way of technology yet. I know there are certain things that people are working on. There's things like Whisper Cash and other things. There's that eCash Act that just came out with the hard wallets, and there's perhaps something around that. But they also have to balance that, right, with this idea of AML, KYC, and money laundering, and that's a very real and arguably an important issue that they have to deal with. And so they're trying to thread that needle. I think that they don't fully. And it's not just the Fed, right? It's every central bank is trying to figure out how do you do that in a way that gives people access to money in a safe and private manner, but while also kind of making sure that the whole system is not going to be turned into one that is just used for money laundering and illicit funds.
So Zeke,
and I don't,
fact, yeah.
Just really quick. I'm sorry, Chris. Yeah. I agree with Zeke again, but and I'll add, I don't think that there's any chance that the Fed would create anything that didn't adhere to the existing level of AML that we have. So that's more than incredibly unlikely for them to do something around that.
So, but given the fact that we ship almost half of the cash that we are printing, so close to $1 trillion is outside of the United States, and what most people don't know, it's actually our most successful export product in terms of profits. It's our second largest export by volume after refined oil products, right? And so it's a tremendously lucrative business, while at the same point in time, I think we are to some extent exporting our values by doing it, right? Because people traditionally, if you look throughout history, I think this happened more than a dozen times when their own government-issued fiat currency faltered. That's what they turned to, and by that I mean a US dollar in printed form. So my initial thought was actually very hopeful in the sense of if and when and where we have a digital bearer instrument that provides the same qualities as this printed paper version, even though it's actually 75% cotton, I believe. But point there being is, I think that's a huge opportunity that we're missing, that we're not talking about. What do you think, Zeke?
I mean, yeah, I mean, obviously, the fact that, all of these stable coins are denominated in dollars just shows the fact that dollars are still the global hegemonic currency, right? I mean, they're the main reserve currency. If the Fed creates a CBDC, then certainly that would also, there'd have to be ways they have to figure out how people around the world can use it if they want them to use it. I'm sure that they appreciate the fact that the dollar is used all over the world. And, on some extent that I don't think they would want to, change that situation. I'm sure Treasury probably doesn't want to change that situation. And so, yeah, I mean, I think that, if you're another country, obviously you have to think about, it's one thing to have physical dollars around the world. Those can be logistically a little bit hard to move and sort of keep track of and all that stuff. But when you turn it digital, all of a sudden that is a lot easier to have it be in your country. And all of a sudden, if you're an emerging economy whose central bank maybe is having hard times and your currency isn't as stable as you'd like it to be. Maybe your policies are inflationary or whatever. Your citizens could turn to the dollar or the euro or any other sort of global reserve currency and use that instead. And that could be a real problem for the central bank of that country and for the government of that country. I'm not suggesting right or wrong that shouldn't be allowed. I'm just saying that it will be an issue for them. And so, I don't think the Fed is worried about, its U.S. citizens using other currencies, although, obviously there was the whole idea with Libra and DM and things like that. And that certainly got their attention, right? Because given the network of Facebook or Meta or whatever it's called now, obviously they were more concerned about that. And if everybody in the US all of a sudden started using that currency, that could be an issue, right? But imagine, that's the same thing that a small emerging economy is going to face if the Fed or the ECB issues a CBDC that's available to their citizens.
Yeah, and you probably saw that Silvergate, which are just down the street here from us, they're an hour away from us, but here in SoCal, they actually bought the intellectual property from that particular project. So it's going to be interesting to see what they're going to do with that, given the fact that they already have the Silvergate exchange network that connects basically all crypto issuers here in the United States. So that's already very efficient. So to provide, let's call it a stable coin on top of that could be creating a huge network effect, just given the fact that they're already connecting all the large exchanges. Mike, did you want to relay a question from the audience? Is that?
Yes, I did. I was thinking Norbert would be good to field this one first. Peter Davey asks, so if payments operate 24/7 because of a CBDC, there's no stop the world I want to get off function to handle a major bank default or something like that across different asset classes, I think. It seems like that could have its own kind of risks that are sort of unprecedented and unexperimented with, and I'm wondering what your thoughts might be on that.
Yeah, I think you could probably, if you're the Fed, I don't think these things are mutually exclusive. If you're the Fed, you could stop transfers from one country, for example. But you could still have a payment network that generally runs 24/7. Stopping on the weekend, doesn't just preclude a bank run or a meltdown in some other country. I think that's probably worrying about or letting the perfect be the enemy of the good. I don't, and honestly, in all transparency, I don't want the Fed to do that. I don't want the Fed to be standing guard on any other economy in the entire world melting down, whatever that means, and ready to shut off their payment system. So I'll throw all of that out there.
That I'm sorry. I just want to quickly follow up if that's all right. It seems like if the Fed has carte blanche to flip a switch and disallow transactions from a certain country or something like that, what's to check their power? If they have the ability to flip a switch and have that sort of absolute control, that could be granularized to any set of circumstances, or even a user targeting as precise as something like Facebook's.
Yeah. The answer is nothing.
Yeah, and look, I think that these are the exact kinds of conversations and debates that not only the Fed, internally, but also wants to have externally and wants to get a better handle on. Like, how would a digital dollar, if the Fed created, how would that reverberate around the world, right? And what are the risks and perhaps the safeguards that the Fed could have in its utility to sort of mitigate some of these risks? Or do they not even want to bother with, do they want to say, listen, these are the risks, but we're not going to like Norbert said, we're not going to be the, safeguarding all banks around the world or whatever. Right. And I think that that's why you're seeing them be incredibly cautious, because there's a lot of due diligence there's a lot of tricky issues, right, with this, and not just from a technical perspective. I mean, I think sometimes we sit here and think about it like, oh, well, technically, this is how you could build a CBDC, and these are perhaps the on and off ramps, and on some level, that's kind of the easy part. Because technology is what it is, and you can kind of build whatever you want. It's more thinking about like, okay, well, if we build it, what are the ramifications, right? And what happens when things go wrong, and who has oversight over that, and whose job is it, right? I mean, it's not the Fed's job to, take care of banking institutions around the world, although on some level, like they certainly don't want to see countries, implode because of their digital dollar, and when you think about, Fed policy now, I mean, they certainly recognize that a lot of countries use dollars now, but that will only get more significant, if we have a digital dollar that can move instantly 24/7.
Yeah.
Do
So
you see?
go
Chris,
ahead.
do you
Mike.
mind? Okay.
Yeah, of course.
I want to ask all of you: do you see any particular way to strike a balance between a kind of Wild West free-for-all, unregulated completely, and giving some authority, this sort of carte blanche light switching of enabling or disabling transactions and things like that? It seems like technologically, it would be extremely difficult to have anything in between those two options without a much larger collaboration of some kind. And so I think it's an important question. Like, is striking such a balance even possible? Have you heard of ways that this might be achieved?
I mean, I don't know about you, Norbert. I mean, I don't know that I've heard. I mean, I think people are still trying to figure that out. I mean, I don't know that I've heard any great answers to that. I mean, I think that there are technological ways of like geo ring fencing things so that like digital currencies can only be used in one country. I'm not an engineer, so like don't quote me if that's not entirely true. But I think the conversations I've had with people is that you could, in theory, ring fence on a geographic perspective, so that this digital dollar or this digital euro can only be used in these specific countries. Obviously, there's probably ways around that from a technical perspective as well. So I don't know. I do also think that we need to, figure out like, how can the public and the private sectors work together? Like, I don't think this is an issue that the Fed or the ECB or the Bank of Japan or whoever it is needs to necessarily solve on their own. I would like to see more conversations around, how can stablecoin technology perhaps be used in partnership with, say, for example, like a wholesale CBDC that might provide like the trust and the support that people, or the confidence that people are looking for, while leaving the technological innovations and also the technological features that people might want, leave that up to the private sector. Because there might be, you might have a situation where, if all these private sector stablecoins could back their stablecoin with, assets or liabilities held at the Federal Reserve, then they can focus on their own sort of product offering, right? And so like stablecoin provider A, B, and C might offer essentially a US dollar stablecoin, but stablecoin A might provide one that's like fully private and fully anonymous and something like that, right? Whereas stablecoin B might say, okay, well, ours is pseudo-anonymous, but we're going to give you this different user experience and you'll have access to these other features, right? And then as customers, we can let it become a market-based approach where we can say, okay, well, I really value privacy, so I'm only going to look at stable coins that are, focused on maintaining that privacy. Or, like privacy is important to me, but what's more important is the size of the network and what I can do with that stable coin. Do I have access to like lending applications or borrowing or savings or whatever? And so, but to ask the central bank to think about all of that, like that to me is a little too much. Central banks are really good at thinking about issues like financial stability and monetary policy, but they're not product managers. They're not going to be sitting here thinking about wallet designs and, DeFi apps and all of that stuff, right? They leave that to the private sector. Obviously they want to think about it from a perspective of like, what are the financial risks or whatever to the system. And so they're certainly very interested in those products as it relates to financial stability, but not they're not going to be the ones to design it.
Yeah, so speaking of stable coins, the paper that we're discussing here mentions that stablecoin research paper. And unfortunately, as technologists, when we looked at this, the single definition of a stablecoin was that of one that's fully backed by a fiat. So that's one of the least interesting implementations that we see, where you have algorithmically created stablecoins. They're more like ODPs and so forth. And if you look at MakerDAO, for example, right, with supply constraints and so forth. So the definition that they're using is really not up to snuff in terms of the technologies that we're looking at on a daily basis. And to simplify this massively, and we're going to have another panel in 5 minutes where we just talk about technologies, but to simplify this massively, the way we look at this, that M1, so what we people call their checking account right now, doesn't really have to exist. As in, if, when, where we have a digital bearer instrument, then there's no reason for it to exist in a state of debasement, right? So even if it worst case sits in a money market account and earns maybe 2% yield, and you don't go out in the kind of more competitive markets of alternative currencies, then you're still better advised just to move from M2 to someone else's M2. So there's really no reason for that to exist from a technology perspective. So, and I'm not sure, and none of the paper that I read leads on that the Federal Reserve is acknowledging that. So Zeke, maybe we'll close out.
Yeah, I'm not sure I agree with you though. I mean, I don't understand why, demand deposits and commercial checking and savings accounts, can't live, simultaneously with CBDC. Like, I'm assuming, I mean, this makes some assumptions, right? But like, I'm assuming that, most CBDCs are probably not going to be interest bearing because they're going to be probably more cash-like in that feature, maybe different in other features. But when you think about, and if we have this two-tiered, situation, when you think about it, like, I go to my commercial bank right now to access banknotes, right, through my ATM. And because of that, right, because I have an account at my commercial bank, I also might have the ability to get a mortgage through my bank or anything else. So I don't see how that would be any different if, the banknotes were now just digital and on my wallet, right? So my commercial bank wallet, I have the option of moving, money from my checking account into a CBDC type thing, right? And all of a sudden then my phone becomes this personal ATM. But for the most part, I would probably leave my money in some sort of interest-bearing account, whether it's a checking or a savings account, although I know today we don't earn anything on our accounts, but it's certainly more than zero. So as a user, I would have no reason to leave all of my money in a CBDC that earns me nothing. I would want to have access to it. And then banks can use that as a platform to offer other services, right? I mean, that's what they're doing anyway. They can use it as a service to say, hey, come and get your CBDC through us, and we'll also help you get, a bank, a mortgage loan or a car loan or a student loan or whatever it is, because the Fed is obviously not going to provide, lending in that sense, and you could do it through CBDCs in another way. But so I still think that the commercial banks and bank accounts, as they traditionally stand, can still live side by side. They'll be different, and their competition will come, I don't think from the CBDC. I think their competition will come from like Web3 native applications, like decentralized financial applications that might offer users, a somewhat higher interest rate on their money, right? So like, if I can put my CBDC in a DeFi app and earn 5%, but I'm holding it in my commercial bank account and I earn 50 basis points, then I'll probably, all else being equal, right? I might think about putting some money in that account, right, to earn more money.
So I'll give both of you a last question with like a one word answer. So Norbert, what is your expectation if and when and where we see a CBDC? Do you think that's realistic that we see one in the next 18 months?
No.
No. How about you, Zeke?
Oh, I don't think we see an actual real live CBDC for 5 to 7 years.
Okay.
We'll start to see pilots and we'll start to see smaller use cases that test very specific features, but those are only just like experiments, right?
Right.
And one that is actually prolific and is used throughout is going to be many, many years in my view. So.
All right, well, we're going to move on to technology at this point. So anybody who wants to weigh on technology, and as I pointed out earlier, this is going to be very informal. So if any of you that have panelist credentials wants to weigh in on the topic, please just turn on your mic, turn on your camera, and join the discussion. We're going to kick it off with Paul, but I think there's a lot of people who have something to say about technology, and I have given 2 hour talks on the topic, so I'm going to try to constrain myself. Paul, you want to tell people real quick what you do?
Sure. So I'm Paul Sistet. I'm with a Dutch company that's developing digital currency infrastructure for the CBDC era. Our solution is called Pay with Glass, and my background is actually telecommunications infrastructure design. So this is an area that I understand in a very different way from the traditional technologists in the space who are coming from the fintech or the banking space directly. One thing I'd like to point out, so my esteemed panelists in the policies discussion made quite a few solid points, and there are a couple of things I wanted to sort of add to before we dive straight into the technology portion. So for starters, we need to be very clear about what the definition of the CBDC in the retail context actually is. For example, Zeke made a great point about the fact that there should be coexistence between the CBDC and the existing checking account or M1 money, for example. And that's effectively what the definition, that comes into the definition space. A retail CBDC is digital cash. So we have to make sure we're very clear about that. So effectively, it is a digitized form of the actual physical cash that we get from whatever central bank. And it is a central bank liability, but it is digital cash, which means it's not something that's meant to replace your commercial bank money. It's not meant to replace your checking account. You will effectively see this coexist with cash and with other forms of electronic money, which is pretty much what we have today anyway when it comes to stable coins and others. So yes, this is a digital version of cash. It's not a replacement for your checking account. It's not a replacement for the other forms of money that we use today. So once we understand that, we have to also understand there's a big distinction, as was pointed out at the very beginning of the policy discussion, between money and the infrastructure that money sits on. And this is kind of segueing into the technology part of the discussion. What's really spurred all of the discussion is around the world, and the movement that central banks have actually undertaken is the movement of China. China has launched their DCEP, Digital Currency Electronic Payment Infrastructure solution, and on that sits their digital cash, the e-yuan. Now, there's a distinction between the two.
I think we're getting a lot of background. We're getting a lot of background noise. It seems from your end, if I'm not mistaken. That makes it hard for people to understand what you're saying.
Okay, I'm not sure I can do much about that because it's a bit late where I am. So I'm in the central library here at the university.
Got it.
Okay, I'll try to do my best on this to make it as clear as possible. So if we look at what the digital yuan and the DCEP project have actually brought, they have opened a new type of economy, effectively. And it's not very obvious just yet what this means, but you have to understand that in digital currency world, there is no need for reserve currency. And I think this is something that the executive order that President Biden signed a couple of weeks ago, in chapter 4, he kind of alluded to a bit of that without spelling China out, calling it out by name, but effectively the national security risk and the sovereign currency risk and so forth were pointed towards China. And this is because the Fed, US government, they've all understood what is beginning to happen here. The digital currency era means the removal or for the need for reserve currency. It also means that the economic power that stands at the end is the one that controls the infrastructure, not the one with the reserve currency. So if you go back a bit and look at what China did, they started working on their solution in 2014. And around the same time, they were pushing very heavily their Belt and Road Initiative. Now, Belt and Road basically was, what looked like a free lunch to most developing markets, and the rest of the world thought, oh, China's doing something, but we're not sure what it is. They're just burning trillions of dollars building infrastructure, roads, and hospitals for all these countries. What is the angle? Well, it's kind of becoming a lot clearer now what the angle was. China has built the infrastructure for medical, for education, for transportation in multiple countries, and those countries owe China. When the world starts moving towards CBDCs, those countries are going to be, most of those countries are the last ones on the list to be able to implement their own CBDC without external help. And this is where China swoops in and says, well, we've already built some other infrastructure for you, and we have this digital currency infrastructure that works really well. Why don't you issue your currency on this infrastructure? So now China has a direct role for trade electronically and economically with these countries, and it creates a new market, a new trade route that's faster, cheaper, easier to use for most of these countries. It also means that the developing countries that are not on this network now have a more expensive and longer path when it comes to trade with China, more cumbersome path to trade with China. So it gives these developing markets an advantage in this new space. It reduces their costs, it reduces the need to go through US dollars. So that cuts out the reserve currency aspect of it. There's a direct trade route economically. And it also means that developing markets that want to trade with China have to either build their own solution or use China's solution. So someone mentioned earlier the idea that the Fed could flip a switch and switch off another country's ability to trade if their CBDC had been issued on the Fed's own system. What about China flipping the switch and switching off another country's ability to trade? Look at the level of power that China would actually have in that market. And that's actually what they're aiming for. That's the future. So the Fed has to do something in order to match that. So there's less of a concern, or there should be less of a concern about the privacy implications and so forth. These are things that can be solved. These are things that can be fixed through technology and through policy. It's more about being on the same level playing field with China, who are actually ushering in the new age.
Yeah, we have the saying. We have the saying here at the fund: technology cannot be uninvented, right? So digital barrier instrument exists, and you can prevent people from using it in some shape or form by penalizing the usage of certain applications. But if the need is great enough, if the pain is large enough, then people will still adopt this. And my consistent example that I make usually for that is there were countries that outlawed voice over IP clients to protect their national telecom companies, and people were still forced to pay by the minutes for phone calls. But then if the pain was great enough, i.e. I couldn't afford to call my relatives, my loved ones in a foreign country, then I would still download a Skype client or something else and place this phone call that I didn't have to pay for. And I think that's largely underestimated when we talk about financial technologies, because this comes back to there's a lot of people that are forced to pay exorbitant fees for essentially moving by. It's what I call they're essentially forced to put stamps on emails, when from a technology perspective, there is no reason to introduce a fee. But unfortunately, we have lots of legacy providers who make 30% of their revenues by just doing exactly that. So I think that there's a big incumbent problem that we need to overcome. It's not so much a technology problem, at least not in the developed nations. It might be different, and that's why the adoption might be greater in the developing nations. So Ahmed, let me reach out to Ahmed and see if he is able to speak, because he should be on this panel. He might be otherwise occupied right now.
Yeah, I'm here.
Oh, okay, cool. Well, do you want to chime in on your thoughts on where CBDC infrastructure sits?
Yeah, just a couple quick points on top of what Paul was saying, and I agree with a lot of what he's saying vis-a-vis network architecture. I think that the really important part of making it sustainable, and as the earlier panel had alluded to, we take the view, I think rightly, per some of the papers reference around financial inclusion as being a primary driver in terms of CBDC issuance, both in terms of the lubrication of what can it do to enable small businesses, retail, and a number of other use cases within the context of what is already now a globalized system, in which now you're adding an additional value asset now coming from central banks. I'd also agree with Zeke earlier that, taking off on a scalable approach to CBDCs is going to take time. However, what is really important here is to Paul's point, and that is making sure that there's interoperability in the pilot phases to the existing fiat, stablecoin, and other digital currency ecosystems that are gaining traction. And that's key to driving both inclusion, but doing so in a scalable way with, as the earlier panel pointed out, importantly, have embedded controls that can address both privacy as well as illicit finance controls in tandem. Technology applications now, with respect to the advent of digital identity provisioning, a utility of credentials of digital identity within the context of the KYC and KYB process, and then the interoperability between fiat systems into digital stablecoin, alternative coin, and CBDCs, that's paramount. Because to the extent that any of that will enable any form of financial inclusion, the digitization of value has already been there. So those are the couple points that I'd want to make to add to Paul's.
Yeah, that's a discussion that Jeff and I have basically on a weekly basis, because in a way, the current implementations of anti-money laundering procedures are kind of bound to legacy technologies. Kind of the fact that we have account-based systems based on database technologies lead to a circumstance where you provide all your fiat credentials, even though you haven't done anything yet, and even though the last 1,000 transactions that you did with your checking account probably didn't require you to share your personal identifiable data with 4 to 5 entities. It's just an externality of the legacy technology that passes this on, because you could probably have just done it by cash. And just the simple fact that you're moving these entries from one ledger, so from one database to another, and involving on average 4 to 5 parties, leads to that particular exposure. So my thesis is on that. So once we have different technologies doing this kind of what I call wholesale surveillance approach to personal financial transactions, should actually in most jurisdictions be unlawful, and they would have to adopt their implementations. What do you think about that thought?
I think, honestly, there is a massive opportunity as a result of this movement to sort of look at those legacy solutions. Yes, we have to have interoperability because we need a smooth transition from where we are today to where we could be in the future. But we have to look very carefully at where we need to be or where we want to be in the future, and take the opportunity that we have in front of us. That's a once-in-a-lifetime opportunity to redesign the infrastructure to include the compliance aspects, to include the privacy aspects, not as an afterthought, because most of the solutions we have today for compliance are afterthoughts. They're bolted on to legacy infrastructure that's been around for 50 years, where these were not considerations at the time that technology was developed. So they've sort of been just strapped on with the duct tape, and they kind of work, but they work poorly, and they slow down the actual infrastructure, and they create all kinds of other issues, and they're not efficient, and they're not absolute. What we need is a solution where we know what the problems are today. We know what the potential challenges will be, what potential challenges we'll have in the future. Let's design an infrastructure solution, so not currency, but infrastructure, which can support multiple currencies, so everything can coexist. And then we need to build things like compliance. We need to build things like privacy into that infrastructure, using the modern technologies we have access to protect privacy of not just the individual who's buying a bottle of milk from the store or a Coca-Cola, but someone who's actually buying a property, someone who's actually going to be paying for university tuition. We need to make sure that regardless of the size of the transaction, regardless of the type of transaction, your privacy is protected. The only time that someone needs to look a little more deeply into what you're doing is if there's a pattern of activity that says, okay, there's some sort of nefarious action going on here, or some sort of terrorist financing potentially. The pattern looks a little bit strange. Let's look a little deeper. And then those who can look deeper need to be those who are authorized to look deeper. So it needs to be the authorities. It cannot be some, Sheriff Thompson decides, okay, well, I think my neighbor might be sleeping with my wife. Let me go look up his information because I have this authority. It needs to be 3 or 4 people have to sign off on this. So there's a massive paper trail. It's not easy to do. It has to be something that discourages abuse of the system. And that's the way privacy protection should be looked at. And then if you have that as a foundation and it's impenetrable otherwise, then you build a proper compliance solution that uses modern technology. So compliance is invisible and it works. This is the opportunity we have.
Yeah, so we draw a lot of comparisons from our early investments 20 years ago when we focused on voice over IP technologies. And so the way we look at this, that ultimately the client solutions that are going to scale are the ones that are going to provide the least friction, that are most user friendly. And so from that respect, the analogy I've been using is, if your CBDC, if your digital bearer instrument of whatever currency that you're providing still has any sorts of friction, then an efficient client technology, we simply kind of least cost around this friction. Because if you don't provide instant settlement finality, and or you require one of the parties to actually expose personal identifiable data, and there's other client technology that doesn't require that, and most people in the world have Android phones where you can just download any non-custodial wallet and there's bunches of stablecoins available, then why should anybody use anything else? Ahmed, do you disagree with that?
Yeah, that's precisely the point. I mean, I'm of the camp where units of value are being perpetuated in the market and have been since time immemorial. I mean, look at M-Pesa's rapid rise in the leveraging of a tokenized piece of value, in this case, telecom minutes. We have to build a future where tokenized forms of value in a number of ways, shapes, and sizes can be used for transaction basis. That's the point of this today. The CBDC push today has actually forced that conversation where you have a number of privately issued that, in some ways with cryptographic technology behind it, in some ways that just have very simple technology behind it, that are showcasing that people store value, issue value, transfer value in a vast variety of different ways. The three important pieces were touched on earlier. One, embedding the illicit finance controls in the construct of the issuance, transference, and storage of that value, right? So the KYC controls and the like. I mean, we've chatted a little bit about this before, and I don't want to go on a tangent, but when we have multiple jurisdictions still by law on paper-based identities, that is a massive barrier to entry, period. Not just financial services entry, healthcare entry, education entry, right? So it begets a lot of different pieces. The ability to understand tokenized forms of value exchange on publicly shared ledgers, et cetera, enable us a greater utility. And in this way, the CBDC discussion, whether it's issued by a central authority, a jurisdiction backed by its own reserves, or privately issued forms of value, have to have interoperability. That interoperability begets broader financial inclusion, and this is what's exciting about the technology, if constructed with that embedded form. So I agree with you, as long as that sort of interoperability play is really part and parcel of the design of the system.
Right. And I'm going to ask David, because we had a discussion about this topic just yesterday, to chime in on that. And David also had some exposure to telecom, so we have a lot of parallel thoughts. But
Exactly. Thank you, Chris. Yes, just as by way of introduction, my background also comes out of the telecom industry, where my role was designing the networks, the mobile networks on the East Coast here in the U.S. with AT&T some years ago. But around 2010, I got involved on mobile payments, and then digital currencies. Have been involved in that full time since about 2016. But this idea of interoperability, I think, is very, very key. Because we've even Amit, in your just the comment you just made, you said, look, it's about financial inclusion. We want to embed these elements of identity along with it. To really make all those pieces come together, you've got to have the broadest access. And interoperability, I look at this whole thing on CBDC as just building another network. And where you want to go with that is to have interoperability available for the existing ecosystem and broad enough to welcome new approaches as well. And you really will find a greater success on the goals of things like financial inclusion if you're not requiring special knowledge to participate, special devices to participate, if you're not requiring that you have a specific software client. If you can strip it away so that the fundamental element that you're bringing people together on is the least amount of information necessary to execute a transaction, you're opening it up to the broadest number of people. And so there's a lot of proposals about, well, offline. How are you going to treat offline? Offline is a special case. And offline is going to drive a lot of technology trade-offs. And you have to really weigh whether or not you want to tie down the currency to be able to be done offline with technology, rather than leaving it open, leaving the situation open so that you can be the broadest accessible solution for the widest number of people, not requiring any special offline technology or device, and make use of the existing ecosystem to the max.
Yeah. So when we started to go to Bitcoin meetups about 7 years ago, I think that every second presentation was mentioning M-Pesa as one of the examples and relatable technologies. And up until yesterday, when talking to you, I didn't actually know that what was it, IBM, right? IBM was actually providing that solution. Maybe
at
you can talk about, maybe you can talk about how this came about, because I find this fascinating. I think a lot of people didn't know that. I didn't, even though I spent all my waking hours in this space.
Well, I was at IBM for about 10 years, and I was working with the communications sector internationally. So, we had clients like Vodafone and Telefonica, China Mobile, Bharti, MTN, and everybody had their own kind of mobile payment. We spent a lot of time with Vodafone and Vodacom and looked at the M-Pesa platform. In fact, IBM was the operator and also had responsibility for software maintenance for the very original form of M-Pesa as it was being launched. And for a number of years, it was actually operated out of the data centers in Europe, not in Africa. And then into late 2000s, I think Vodafone was looking for the next generation of the M-Pesa technology. And I believe they ended up on a totally different platform now, after they had worked in Tanzania, South Africa, and a couple of other countries. I think it went to Huawei, but I'm not positive about that. So
was it IBM's brainchild, or was it Vodafone initially?
No. The concept came from Vodafone. Everything non-technical about how you represent minutes as this currency was from Vodafone. But it was the implementation, just the practicality of expecting Vodafone to build and maintain a payment system that was handed over to IBM. But no, IBM did not, as far as I know, did not define the service like that.
Yeah, because I mean, I think if you're living in the developed nations and you haven't exposed to like an African continent, you don't know that some people will pay sometimes daily for their minutes that they want to use, and just go into one of those stores and deposit $5 for the daily usage of their phone, because that's all they have at that point in time, right?
Right.
And I think it's important to keep these edge cases in mind when we talk about these technologies, because coming back to, if we actually want to not bank the unbanked, as I keep saying, we're going to unbank the banked. That's kind of the objective here. But if we want to provide financial inclusion for the 1.7 billion people that are right now entirely excluded from any digital technologies in that sense, then we need to know about these constraints. So when we started looking at payment solutions for that space, there were like simple hurdles that we never thought about, i.e. a lot of people have Google phones that just have very limited capacity, just very limited storage capacity. So these providers that were pitching us said, well, we had to entirely design the app to just work within these constraints, right? Because everybody now just here probably feels like, well, I'm just going to download an app and there's always going to be enough space available. Well, that's not the case for hundreds of millions of people around the world that could be a new client. So Ahmed, on that note, like when you guys are building technologies, is there something that you screen for, or how do you go about like defining what your TAM is, what the total addressable market is for your solutions?
Yeah, it's funny. That the TAM conversation is always amusing to anyone that has to talk to an investor, right? Because at the end of the day, when you're talking about what's the total addressable market, we continue to see that the addressable market is growing. And the reason why we say that is because the truth and the reality is, and Christian, we've talked about this, Paul, you and I have talked about this ad nauseum, with a little bit of software and the right partnerships, any organization on the planet can be a financial services organization because of the advent of tokenized value, period. Which brings in David's point on interoperability, right? So when we think about our solution and the quick background, we're a hybrid fintech, regtech platform that brings together a number of AML, KYC, KYB solutions in one service offering so that you don't have to piecemeal a lot of regtech applications that a lot of bank and non-bank financial institutions have to do. And it's built for DeFi, it's built for blockchain networks, it's built for traditional financial services. And the whole idea is to create interoperability across the regtech stack, be able to enable digital credentialing for those that go through a KYC, KYB process. So you create a utility within the system. That's the core of what we're doing. So when we think about the addressable market, the one thing I would come back to is that if folks in the conversation here believe the earlier statement, which a little bit of software organizations can be financial services entities, and I feel strongly about that because, I mean, other folks have said this. Walmart, Google, Apple, they're all financial services companies, right? There's a lot of organizations out there that are providing what traditional banks have done in the past and now doing from corporates, e-commerce marketplaces, and the like. One common denominator is the expectation is that the illicit finance controls, fraud controls, terrorist financing, money laundering controls, know your customer controls are being increasingly seen as the at least the common denominator. You have to know who your customer is, period, right? In an increasingly non-intermediary world, who does that obligation fall to? It falls to the technology apparatus and the users that are interfacing. Because at the end of the day, if I'm going to send tokenized value, even on a peer-to-peer basis to David, I care that my tokenized value is going to David, that the wallet that it's going to belongs to David, and that there's a corresponding net debit and credit between those two, accounts. That's what I care about. If there's an intermediary involved, the traditional model has been the intermediary or the on-off ramp is who's responsible. With a non-intermediary environment, where you're an issuer, or a transfer, you're a storage of that value, that construct needs to be embedded. And so from an addressable market perspective, I look at technology companies, platforms, e-commerces, and marketplaces as equally a growing addressable market as traditional financial services and now non-bank fintechs and crypto.
So in your model of the world, are you actually passing on PII or just passing on a green check mark?
We are enabling the ability to verify credentials associated with an individual or an entity without having to pass along the PII.
Okay. Yeah.
That's the key. And then that's good for both KYC verification. That's good for travel rule compliance for all the compliance geeks out there. That's good for a number of different things that are required in the financial services regulatory domain.
Yeah, and then so
it's a bit more sophisticated than complicated than the check mark, but it simplifies the process in the way a check mark would.
Yeah, so that's a kind of a off-the-cuff question, but has any of you been exposed to the issuance of the new digital driver's licenses that just became online and knows how these work in the context of payments and credentials?
The jury's out.
So that's not a question I can answer.
Yeah, I think it's super early. I mean, I'm excited personally in seeing digital identities, being pervaded in the context, say, for example, of driver's licenses. But again, the challenge is always in the adoption phase. If only a few are providing the ability and others aren't, that kind of interoperability is hampered when certain providers, verifiers are enabled and others are not. So that, we need kind of a consistency of approach.
Yeah, I mean,
it speaks to standardization, and this is the same issue with CBDCs. I think at the end of the day, any CBDC initiative needs to be properly planned, and standardization needs to be a part of that planning from day one. Otherwise, it's everyone doing their own thing, nothing works, and then everything's an afterthought, and that's where the problems come.
Yeah, and I think we're going to talk about interoperability specifically in about 3 minutes here. And so maybe as kind of a closing thought there, and that's why we spend a lot of time on what people keep calling digital identity, which I really refer to as agency and attribution, the agency attribution layer of the digital space. But again, that's because I have a law background, and it's really not about identity, right? Identity requires consciousness, but the larger point is really in the context of transferring value. That particular primitive is the more important primitive ultimately. So as in, can you actually access control over something? Because ultimately this is about providing property rights, right? And they are specifically to people who right now have a hard time controlling anything that's digitally or anything that can be digitally represented. So that's why we think that ultimately applications like digital land registry that are NFT based will take hold first in countries where they don't have any infrastructure, right? So, but it's the same point here, right? Money is just, currencies are simply the easiest primitive in that sense, because the metadata that you're transferring is very limited. So with that said, John Kiff, do you want to join us for the interoperability panel? And then anybody else who wants to jump on that? I think David had to jump on something else. Hey, John, do you want to introduce yourself real quick so people know the gravitas of your opinions?
John Kiff, aka Kiffmeister on social medias, ex-Bank of Canada, ex-IMF, and now a totally free agent, so can speak my mind without checking with the boss.
Yeah, and you get bonus points if you recognize the PVP, the profile picture that John is using on LinkedIn. You have to be an insider for that.
The first time I met John was at the IMF, and I'm standing next to him, and he introduces himself. No, you can't be that guy. I'm looking for this guy.
Yeah, I'm looking for the guy who looks like Johnny Rotten.
That was me a long time ago.
Well,
I spent 25 years at the Bank of Canada, 16 at the IMF, so you can take a guess at my vintage.
Yeah, so I remember Johnny Rotten well from my time in Great Britain back in the 80s when I was an exchange student there. But yeah, yet another topic. So yeah, we want to talk specifically about interoperability. I think there's a number of different issues here. So David and I were talking specifically of what I would call like the lowest common denominator yesterday. And so I think of your DID, and again, DID has many different translations. For telecom guys, it's always direct inward dialing. For others, it might be dissociative identity disorder. And then for most people that I talk to lately, it's about a direct identifier of sorts in the Web3 context. But yeah, David, can you speak a little bit maybe to the ITU's thoughts as far as you know?
Yeah. So there are a lot of different efforts that are all happening around the world to try to bring some structure to this whole topic around how do we introduce new methods of making payments. And the International Telecommunications Union in Geneva has some working groups and some focus groups. And I probably have the name wrong, but there's one for digital currency focus group, which now I think is a working group. And in that forum, there have been some excellent contributions, one of them from Jacques Francoeur, on how to establish an ontology and just a nomenclature for the different ways that we all seem to try to talk about the same thing. You know, one of the important things we need around interoperability is to be able to think about what are the elements, the atomic elements of digital currency, its form, its purpose, how it's presented. And what are those common elements which build up to how are you going to treat this idea, this element, when you pass it from one jurisdiction into another jurisdiction? How do you structure it so that it carries with it the same consistent type of treatment and information? And that's where this work from Jacques Francoeur is really focused on making definition around just elemental what is the structure of what a digital currency is and how it moves. You know, you've got digital currencies that can exist in static form, in dynamic form. They circulate within closed loops, and you have this concept of conservation of currency, that, you know, the value there isn't going to change unless there's some action taken on it. So that's helpful in this understanding of interoperability, especially when the industry starts to turn towards cross-border.
And David, is it okay? You shared the document with me yesterday. Is it okay to link to that when I update the article on this discussion? Is this public?
I'm not sure how public it is. I have no idea.
Most ITU documents are fairly public. I'm part of the group. I'm working actually now. I'm partnering with Jacques, so we're trying to push this ontology over the finish line, and it's really tough because we're trying to. There's kind of a trade-off here. You could start listing off all kinds of characteristics and end up with a list of a zillion different characteristics, but that's not going to be useful to anybody. So we're trying to shrink it down to something very more parsimonious, while still capturing all the essence of a digital currency. And we're starting to now, for instance, expand out to not just the characteristics of the currency itself, but the ecosystem in which it moves, because you can't avoid talking about that at all. So it's been a real slog. We thought we'd be done sometime last year, but you know, we're still slogging our way through this thing. It's amazing where we've come from. We started with I think a very simple ontology or taxonomy with about, I don't know, a dozen or so elements. We're now into probably the many dozens, and we meet twice a week, and we color all the things that we think we've nailed down green, and the ones that are black means that we got to work on them. And it seems like the number of black ones keeps expanding, and we roll back greens when we look at it and say, no, wait a minute, we didn't capture that properly.
John, there's a term for this.
Also, the interoperability is not just a global thing. It's also within a country. Like most central bank digital currencies out there are operating on the so-called intermediated model, and they're giving us some latitude to the intermediaries in terms of the kind of wallets to use. In some cases, the central bank kind of says, here's the wallet, this is the one you're going to use. Others are saying, you know, do what you want. We distribute the DC to you, you do your thing. Now, I think one of the most important fundamental characteristics of CBDC is that it be fungible throughout. I don't want to be in a situation where I have a CBDC on wallet of Bank A and you've got one on Bank B, but we can't transact. You're no better off than you are when you have the current family of different digital currency media. If you're in China, you go to Alipay. Can you pay across to WeChat Pay? No, I don't think so. So that's not a CBDC. You need to have interoperability standards for that too.
Yeah, I mean, in a way, so outside of telecommunication, currencies are the ultimate network technology, right? And I think what people ignore is that the US dollar imprinted form is the ultimate network technology de facto, right? So I can take a $5 note and it can walk into most stores around the world that will happily take that particular piece of paper and give me their wares for that. And I think that's largely underestimated how powerful that is, because what we see is where most of the friction is not really in the technology, it's cognitive friction, right? I need to recognize that something has value. I need to recognize it as my language of value, because that part is really hard to get out of people. If my indoctrination is that I look at a house and I think of it as $1 million, it's going to be very hard to understand, oh, this is what it's going to be worth in Bitcoin or in Ether. So that's why I keep telling entrepreneurs that into payment solutions where they introduce a new unit of account, this is like, okay, you're requiring people to all of a sudden learn a new language before they can adopt your technology. There's no greater friction that you could possibly introduce. But then back to like this telecom example, for me, what's so fascinating about this is there is a regulatory global framework for that, right? So as in, if you have a local DID, of your local phone number, then it comes with certain rights. I can receive phone calls there, but what is a phone call? A phone call is a message. What is a payment? A payment is a message. It's a message of value, right? So that's what I find so super interesting. And that's why I was very surprised that I had to actually hear from Zeke only a few like weeks or even like days ago that the ITU has an effort there. So I'm super interested to pitch in on that, because incidentally, my doctor thesis was on number regulation. Full disclosure, I never defended it. I got too busy building startups. But yeah, so David, I think what we should look for is kind of the lowest common denominator in terms of being able to transfer funds, if I look at this the correct way.
Well, if I may chime in here for a bit. So John, I was going to make the point that you guys are now in that space that we call paralysis by analysis, where you end up being stuck on what it is you're trying to do rather than actually doing the thing itself. But we've been there ourselves. So my background, as I mentioned, is in the telecommunications space, and like you, David, I've actually also been designing telecommunications networks and cloud and data center infrastructure for about 20 years now. I've also, so I brought this into the payment space where we kind of started around 2011 with Bitcoin, experimenting on how to actually solve this problem of the legacy systems for a long time. And the interoperability question came up quite early on. We realized, hang on, this is perfect. We have this experience with telecommunications. The standardization came in the form of TCP/IP. We need the equivalent for money. And if we can create that kind of standard across all forms of money, then we basically have a set of rails that work everywhere. So if that's the foundation, and money itself is simply just, the unit of value is simply just a store of a value that is, as you said, is fungible. But the key is that it can move smoothly across this set of rails. And if you move all the other bits we were discussing before, like the compliance, like privacy concerns and so forth, to this set of rails, then you have a construct that's already been proven in the telecommunications world that can be brought to the financial services world. Interoperability then becomes less of a challenge at that stage. It's more about what do we want to make interoperable with the system. So where are the on and off ramps? Is it a case of interoperability between currencies, units of value? Is it interoperability between existing systems, older legacy networks and systems? Is it interoperability across countries? As long as we have that standard set of rules that everything sits on, instead of defining the actual interoperability at the level of the money itself, define it in the level of the payments network. Because ultimately, when we have digital currencies, we have them for a reason. We're not just holding onto them. We need to make purchases, we need to trade. So we do need some sort of payment rail to allow that transaction to occur in the first place. So why don't we start with the same definitions that we've had from the telecommunications world?
Yeah. Paul, it's really still difficult Paul, it's really still difficult to hear. You got a lot of background noise going on. I think a lot of people will be having a hard time hearing you. So maybe I'm going to reach out to Daniel. Daniel, maybe introduce yourself real quick and on any thoughts that you might have on interoperability.
Hi, how are you? My name is Daniel Truque. So my experience is I actually started my career as a consultant for McKinsey in the risk management practice, and did some banking, fintech. More recently, I've been everything in blockchain, from permission blockchains to developing quantitative investment strategies and advising banks on accepting Bitcoin payments, and even advising mining projects. So a little of everything. I'm an engineer at heart, and I love teaching, so I always like going to the weeds on this type of things. With interoperability, one of my pet peeves about it is that this shouldn't be, when people say interoperability, it's almost like they claim it's kind of like a blockchain talking to another blockchain. We're never going to have that level of interoperability unless everybody's using the same underlying consensus mechanism, which is very unlikely. Even now, like just this morning, I was on another workshop with John, where he was going over all the different projects that are being done worldwide in CBDC, both in retail and wholesale. And kind of like the key takeaway there is there's a lot of things out there. None of them seem to be following the same path. So like we're not going to be working with close enough systems that they can talk to each other. However, making bridges from one ecosystem to another one is easy depending on the level of trust that you want to put on it. If you want to trust this bridge, yes, you may require some more compatibility at the infrastructure level. But if you are able to have a trustful bridge, where essentially you have a trusted agent that sits in one network and on the other one, then that may work. So in the case, let's say that indeed the Fed launches a CBDC, they could run a node on the US Fed, on the US Fed coin, call it, and then they could run a node or be somehow a part of the Great Britain, the England CBDC network. And then if an American wants to get pounds, they can do it via the Fed, who is acting as a trusted agent there. Or it doesn't need to be the Fed, it could be a commercial bank or any other trusted agent. And in those cases, those trusted bridges are very simple to bridge. That's to build. That's not a big deal. So what I want to say there is essentially that technology choice shouldn't be guided by the hope of interoperability.
Yeah, I mean, ultimately, adoption will work in two ways, right? So if it's mandated by the government, or if the technology by itself just has a really, really high net promoter score, and a lot of people just find a lot of value in that, right? Yeah. So that's how we look
or if the economics drive it, but you have to kind of start from where we are now. Mm-hmm. And, where we are today is in an environment where there's the rails that are in place now. And if we're going to begin to introduce CBDCs, even as the other guy talked about earlier, maybe not even for 5 years or so, mm-hmm. You're still going to have the same ecosystem broadly in 5 years. Right. And so you got to start from where you are. It won't be a stepwise, all of a sudden, introduction of a lot of different, it's going to be kind of step-by-step evolution. You want to build the interoperability among the networks that are there essentially today and focus first on those.
Yeah, it needs to be backwards compatible, right? So that's what I often notice, and John, you probably noticed that too. It's just a lot of engineers are not aware of the existing, let's call it, data exchange formats and systems and the metadata that they currently carry with them to make things work, right? John, yeah.
Yep.
So maybe you can speak a little bit to that, because I know these standards really, really well from like the travel space, where that is an integral part. Unless you know of this particular metadata that you need to carry forward, you can't actually build a client technology that can serve that space, because you don't know that there's such things as exemption codes, right? That need to be passed on down to a very old data format called artifact that needs to be able to spit out on a telex machine, right, for example. So maybe you can speak there specifically to like the legacy system, the legacy standards within banking and finance.
Yeah, that's not really my shtick, actually. So you might be asking me the wrong question there. And what I was going to say was that, I think David was mentioning that the ITU work is meant to be public, and actually it's meant to be very open. Everybody on this call can join. It's totally open, and I think that's going to be how we're going to embrace all the different technologies out there, and embrace all the different dimensions. I think we've got to have a lot of different people weighing in, because right now we're just a small group, and we're going to be what we end up with is going to be influenced by that small group working with the current technologies. Not just CBDC; it's actually a digital currency ontology and taxonomy project.
Yeah, well,
and there's risk, as Paul said, that the paralysis, right? Analysis paralysis. At some point, you have to kind of lock the pin in, but it doesn't feel like we're really close to that right now.
Yeah, it's not an area where you can move fast and break things usually, right? In banking and finance, that doesn't really apply here, and that's what most people are trying to do, unfortunately. So right now, and I keep saying this, the whole quote-unquote cryptocurrency space is kind of more or less a multi-massive online player game, because it's utterly disconnected from real-world economic activity, and that's mostly because people don't understand that they have to be backwards compatible with the legacy system. So there's, in my opinion, and I want to see how David feels about that, there's not enough time that developers spend on that aspect trying to understand the legacy system. They're kind of looking forward without knowing the trajectory. Right?
Some of that's I think a really good point, Chris, because what we're seeing come out of this cross-border topic, broadly, if we go back and look at the introduction that Facebook had with Libra, it got everybody, somebody brought it up earlier, right? It got everybody all of a sudden paying attention here, and there was a real determination that, okay, there are frictions, there are problems in the existing system. And that kicked off this whole issue with the G20, and they brought it out to the Financial Stability Board and to the BIS, Committee on Payment Market Infrastructure, CPMI, to come up with a roadmap for addressing it. That roadmap is a combination of addressing the existing systems, driving improvements on existing systems, just as much as it is about introducing new things or new technologies. It's a combination of both. Okay, that was some noise. It's a combination of both. So I think the point I want to make about that is there's a lot of room to make improvements with the infrastructure we have now, with the systems we have. They're not only technology improvements, they're business process improvements, like somebody brought up earlier. Just the fact that these exchanges don't operate, they have limited operating hours, is something which could be addressed. So there are opportunities to improve the existing systems and at the same time start to lay the foundation of making it more open and like you've been talking about, by paying more attention to the metadata that's needed to increase the interoperability.
So John, what do you think is the most important topic that people don't realize? And by people, I mean mostly developers in kind of our space, what people call the blockchain space, that they should be paying attention to from your perspective.
Well, for what I mean, I come from a policy background, right? And I've been involved at the FSB and the BIS level, and so I think everyone should be paying attention to the principles that are being laid out by those institutions, and I've laid them out very, very clearly. The G7 published a paper last year with I think a dozen principles. Absolutely, you have to follow. And then 2020, the BIS and a collection of central banks offered up their version of the same thing. I think everyone should be paying more attention to that. I hear a lot of discussion in the context of the digital dollars, though, that it's something that stands alone. I don't hear anybody talking about the need to comply with these international principles. So we talk about interoperability and standards, but that's when you're working in the weeds. But I think from the top down, the designers of CBDC should be very conscious of these higher level principles, and if they don't like them, then they should be weighing in to influence those principles. So it's kind of coming at it from top and bottom at the same time. I think it's important not to ignore that top level.
So does it refer back to our introductory discussion that we had about currencies being a public good? Is that how you think about it?
That's right. Yeah, I mean, I think the overriding principle is do no harm. That's
right.
That guides everything below it, all the details.
Yeah, that's super important.
I do agree as well, John. I think one of the things we need to consider is if we don't have a solution that's interoperable across borders, then we only have a domestic payments network. So if we want to have CBDCs that work internationally, we need some sort of interoperability across borders. And to your point and to David's point earlier, it's a case of, yes, it will take several years before a solution is mainstream and everyone's using it. And during that time, we have to make sure that we're backward compatible with what's over there. Otherwise, we won't have adoption. You can force it as much as you want, but it's not going to happen. So you do need interoperability from both of those standpoints. And standardization is a major part of making sure that interoperability works. So the designers do need to take that into consideration, but they also need to look at it as more of as less of an economic modeling issue, and also take.
Well, you're very far away from your microphone. I don't think many people can hear you. Sorry. And so, yeah, I think we're also a little bit behind on our schedule here. So maybe we're gonna move on to the next topic, which is the topic of private and or public CBDCs. And I think John and David and you too, Daniel, have something to say about that as well. And then I think we're gonna ask Benny if you're here to join us as well. Mr. Bartlett, if you're here, please join us if you can, maybe as a background, because Ben is heading the Calcoin initiative, which is an interesting thing to talk about if he has time. I see him as a guest here, but he might be busy on Berkeley matters. So, John, is there any private initiatives that you see that central banks look towards, i.e. the typical just stablecoin peg, Circle, anybody else that you think the Federal Reserve is paying greater attention to and take more serious, or are they entirely insulated from that? Because from what I can tell, looking at their stablecoin evaluation, that seems to be very much surface, as in no deep dive has been done on any of the existing technologies that we look at on a daily basis.
Yeah, I mean, I would suspect that most central banks, not just the Fed, they view the stable coins as something else. Stable coins are a stable version of a cryptocurrency. That's where that ends, and they're building something out that's maybe influenced by the technology. They might be there, for instance, many are being based on distributed ledger technology. Not all. There's a misconception that a CBDC, by definition, is going to run on distributed ledger technology, but in fact, it comes in all kinds of flavors. David knows that well because he was involved in the Uruguay pilot. Definitely not DLT. Jamaica's sand dollars based on a digital bearer instrument concept. So they're to think that all are looking to stable coins, or any are. I think they're looking at the technology underlying stable coins as possible, but they've all gone, of course, with the private permissioned versions of those technologies. I don't think anybody's seriously looking at a public unpermissioned network. That still goes against all the principles of central banking. You'll never see that, I don't think.
I have to agree with you, John. I think, especially if we're talking in the context of the United States, I think there is really zero chance that the U.S. would decide for a digital dollar, for central bank digital currency, to just adopt an existing solution coming from an industry player. And I certainly don't think there's any chance that they would adopt one of the existing stable coins. And partly I really do agree with one of the comments that was made earlier when we were talking. I think Ezekiel was saying, look, the Federal Reserve is much more involved in this than they make publicly available. And there are enormous resources that I think are already going in, intellectual resources that are going into exploring a lot of different paths. I know that we started the day talking about this paper that came out in January, and since then there have been other materials that have come out from Project Hamilton that describe a little bit more about the different technologies that they're playing with. But even the Project Hamilton paper that talked about two different approaches that they took to build and try something, they also don't represent what the Federal Reserve ultimately would do. They truly are just playing around and learning and experiments on this. I really think that for the U.S., they want a public solution. It is entirely possible they may create one of their own, but they are spending a lot of effort to really be well educated about the technologies that are out there. They don't take it lightly at all. They really don't.
Yeah, I mean, I was surprised.
By the way, you may know that the IMF is really keen on what they call a synthetic CBDC, and yet not a single central bank has moved in that direction, and none are. And the ones I speak to about that say, my buddies at the IMF, they love this synthetic CBDC. Just for those that don't know what it is, a synthetic CBDC is essentially a stable coin that's backed by central bank reserves. So it's kind of like Tether, where Tethers invest in all the underlying assets at the Fed. And one of the reasons they say that they're not interested is that what you're creating with this synthetic stablecoin, which is supposed to sort of somehow insulate the central bank from all the donkey work of running a CBDC platform. They say, first of all, that's not a lot different from how we could design an intermediated model. And in any case, you're creating this too big to fail or too important to fail thing that isn't going to insulate the central bank from an implosion the platform, the stablecoin platform.
Yeah, so one number or two numbers that I came across in my research were really fascinating. I didn't know that the Federal Reserve System employs 23,000 people in the United States, and with almost 3,000 working for the board. So does anybody on the call know what they are all doing all day?
So the answer is no, but I can actually tell you that, at least like kind of like to piggyback on what John and David were saying of what's going on at the Fed. I've spoken to several groups at the Fed, from the Fed Boston to like people at the Federal Reserve Board in research to like the financial stability people, and then now I guess kind of like the fourth contingency that is coming up is the people in charge that will be executing the Biden executive order. So if you think about the guys in Boston, yes, they're all over the technology, they're playing with it, and as David pointed out, they're playing with it, but I don't think anything's going to come out with it. And I believe forget which was the guy from the guy that I know is Jim Cunha was the one originally running that, but there was another guy that I saw and heard on a podcast recently, and he was mentioning, he literally said, we're not gonna deploy this. We're still learning. We're gonna look at more technologies. Separately, at the Fed board level, both in the financial stability guys, we're more worried about what are the effects of both stable coins and the implications in terms of bank disintermediation and other stuff if we were to do a CBDC. And one of the research guys actually said something very interesting, and he was like, this is not meant to represent the view of the Fed, but I know a lot of my colleagues share this. The Fed is not in a position to out-innovate the private sector. The Fed is not in a position to operate a stable coin or a CBDC. It's just not what we are. We have to like build something completely new. And he said, like, I just don't see anything like this happen. 3 months later, Biden's executive order is essentially ordering a bunch of different agencies, go change the law, explore this, let's make this happen. So whether driven out of FOMO or like just some type of like risk management, etc., I just don't see a single opinion or a single direction within the Fed. There's definitely a lot of resources being put to it. Not to say they're not coordinated, but at the least they're not in consensus.
Yeah, I guess that automatically leads us to yesterday's announcement and is it eCash? I probably butcher it. eCash bill. We talked about this a little bit earlier, but that's kind of the idea of, in a way, sidestepping the Federal Reserve altogether and kind of taking them out of the equation, it seems like. John, do you see any reasonable chance that this will get traction?
I really don't think so.
Yeah,
I mean, I think it's just it's led by a group of people who are very passionate about the concept of a truly cash-like digital currency, and then they're using this as an opportunity to push that through. I mean, I'm very keen on it too. I wish the Fed would take a serious look at offering up a truly digital, offline bearer-style digital currency. Well, because from my we've talked about this before. I think this is a use case that's really this is a unique use case that might drive interest in the CBDC. I think otherwise a digital dollar is, as Waller said, a solution looking for a problem. Because let's face it, like there's a number. If you sort of parse the U.S. population in terms of the banked and the unbanked, and you take the unbanked and try to find out why they're unbanked, do you really think that offering up a CBDC is going to draw much interest from that group? I really don't think so. And then looking beyond the U.S., you do need that offline capacity in countries where natural disasters can pull down the whole infrastructure for long periods of time, or you got huge parts of the population that don't have access to internet at all or can't afford smartphones and feature phones. For them, they need something that's, I think, closer to what real cash is.
Yeah, and I think I'm summarizing it only halfway and hence butchering it to some extent, but most people, at least in the United States, are unbanked because A, they don't trust banks, or B, they don't have the necessary government credentials, and then lastly, because they don't they're not worthy, so to speak, of being banked from the bank's perspective, right? So, but none of these three reasons lend themselves really well to be solved by the current discussions around the central bank digital currency, I think. And yeah, which is really unfortunate because yes, it has been kind of the battle cry. We're doing this for financial inclusion reasons, but then when you look behind the scenes, that doesn't really hold up as far as I'm concerned.
Yeah.
But the other point that I wanted to make, since we're talking about private versus public, I think what hasn't been done enough yet is simply observing the current use cases, i.e., so traditional use cases of what we call money, which to me, money is just an agreement between two or more people. Currencies are the systemization of these agreements. But there's really only three use cases if you think about it. And the Fed likes to talk about the payment part, when the primary use case of government issued fiat money is really that of lending. And then the secondary part, which is ironic, is store of value. And with now M2, so money market account certificate of deposits, being the largest store of value for the first time, exceeding actually outstanding mortgages out there. But the point there being is, I think what we need to do in more nuance is identify the current use cases that we see. I'll make one like very simple example. So we were talking about stable coins earlier. The largest stable coin by market cap right now is Tether. But you can readily observe the use case of Tether, which is quite simply to stay on a centralized exchange and exchange that against BTC or Ether. So the use case for payments and so forth is non-existent. So I think that's a very important thing to realize, as in it should be mentioned that there's new use cases that are not addressed by the legacy financial system and by legacy government issued fiat currencies that haven't been part of the debate at all. And so then we can go into like more esoteric products that couldn't exist on the system, i.e. automated market makers, right? So that there might be something that a Federal Reserve member has never heard of. Or what do you think, David? They know that these things exist.
Listening to what you're saying and thinking about use cases, what got me interested in this particular topic of public-private is that I personally am trying to really understand the boundary between the public domain responsibilities and functions and the private sector industry's ability to participate in it, enable it, and deliver on the promise that this should be a social good. So I think, making it a social good inevitably is going to have to involve public and private. And I really am trying in this entire CBDC discussion largely to understand that boundary of public and private. It's a boundary across several different realms. You've got the technology difference of public and private, the regulatory difference, policy difference. So in each case, how much responsibility falls on one side of the boundary or the other? Where do the risks fall? Who's got we just mentioned a few minutes ago where we think the center of gravity of technology is going to fall. Is the center of gravity of technology going to fall to the Fed inventing their own system and operating it themselves? Or is it going to be something that they work together with the private sector? And in that regard, I quite like the model the Bank of England proposed in their discussion paper. I forgot when it was. Everything in the pandemic kind of blurs together. So it was a pandemic paper from the Bank of England that was a discussion paper where they said, look, think of the Bank of England having the core ledger. And they're responsible for the resiliency and the integrity of the fundamental exchange and the value. Put a layer on top of that for the private sector where the innovation is going to happen, and let them implement methods for programmable money, smart contracts, and all of this as a value-added layer that is left to the private sector where they can build value and be compensated for that value on top of it. And so having this kind of dividing line between where the public sector takes the responsibility and what they leave to the private sector. So I spent a lot of my time trying to understand that kind of boundary, which I'm sure is a blurred line, maybe, probably not even a sharp line. And that's when I started hearing you talk about this public-private thing. My mind went to that.
Yeah, that's interesting. So if Ben can join us at some point in time, would be interesting to get his perspective. And for reference, before he can join us, and if he can join us, I'll just summarize it real quickly. So Ben was heading the Skullcoin initiative. It's essentially the idea that you create a limited stablecoin to replace the food stamps program here. And so there you would have the benefit what you just touched on, that you can make it programmable, i.e. these are certain funds that can only be spent on certain goods, for example. And that's something you need to be able to implement in a technology fashion so that people cannot buy, I think it's like alcohol and tobacco you can buy with that particular quote unquote currency in that particular context. But that speaks then also to a more decentralized effort, right? So to where it's not the Federal Reserve System, might actually be individual states that are driving this particular innovation forward. John, have you seen similar efforts and discussions like that, where it's not the central bank, but where there's like state efforts that are trying to implement this for their particular needs?
Well, I've been calling those gov coins, and they are starting to pop up here and there. They've got city coins also that can only be spent within the city. But there's also, I think was mentioned earlier, that even the federal government itself has different kinds of programs that run on special little cards, stored value cards that can be used for only certain purposes. But developing a CBDC with those kind of powers, I think, wouldn't go over very well. Whenever I've mentioned that in public, I get a lot of flack for that. I mean, the idea of the government controlling how I spend my money, that wouldn't go over well. But I think it would work well in the context of like a digital version of food stamps. And so I think Zeke might want to join us on this too. He's got some very interesting thoughts on the use of the technology to, for instance, to increase the velocity of money. If you want to have stimulus payments that actually really kick in hard, you can have depreciated money. It's called Jezel money. It's actually an old concept, goes back many, like a century or something ago. But maybe Zeke might want to join us on that topic.
It's kind of, and I hope he does join. Yes, thank you, Ezekiel. But I was actually in a conversation with a central bank earlier today where this came up about how can you limit the use of the CBDC at the product level. Like we want to give social benefits to the population. We would rather they not be used on things like alcohol, for example. So how do we control for that? And I think that links us, ironically, back to the topic of interoperability, because to be able to do that, you need a deeper level of integration at the merchant level to say, if I pick up my basket full of 16 different things and walk up to the register to cash out or to pay, you got to know what's in that basket in order to regulate whether the funding that you've allocated for it is permissible. And that's a deeper level of integration with payment systems than we have today.
Yeah, fun fact before I let Zeke chime in on that. So the federal government sent stimulus payments to 1.1 million deceased people, totaling about $1.4 million. So it comes back to the fact that we just don't have an efficient payment mechanism in that context, right, Zeke?
Yeah, no, I mean, I think that this idea of the stimulus money is the perfect example. And thanks to John for giving me a shout out. I think obviously the programmability of digital currencies makes some of this possible that wasn't really possible from an efficient perspective. I mean, so John alludes to Silvio Gesell, who was I believe Austrian, maybe German economist back in the late late 1800s, 1900s, early 1900s. Anyway, this idea that, when it comes to economic stimulus, right, that we've seen with COVID, the whole point of it was to make sure that if the government is giving people money, they want that money to be spent And specifically, they want that money to be spent in their local economy. So whether that's local specifically to a city or a state, or more broadly speaking, local to a country. And unfortunately, what you see with past stimulus checks that many people have received, whether it was this recent COVID round or back in the 2000s and stuff like that, is that most people end up saving the money. I think something like 80% of all the money is either saved or it's spent on past debt. And so therefore it doesn't really have that same economic stimulus that people want. And so one of the ideas that I've written about, there's also a great economist at the St. Louis Fed, David Andolfato, who's also written about this. He calls it hot money. But the idea is that, with programmable money, you can incentivize people either using Silvio Gazelle's idea of sort of demurrage fees. So essentially saying, listen, we're going to give you this money. And if you don't spend it within the next week or month or year or whatever it is, we're going to start to claw back, the value of that money. That's one way of doing it. You can do it in a positive way instead of taking money back by saying, listen, if you spend this money in the next month or week or whatever it is, we're going to then give you a bonus as well. And I do think that like the stimulus money could be a really interesting way of looking at it. I don't know that it would be necessarily done on specific CBDC money, because when you think about, if people are holding CBDC money as part of their savings and, their checking accounts, you wouldn't want that all of a sudden to create, to have demurrage fees. So it would almost be like a subcategory of CBDC, right? Like a stimulus CBDC that was kind of only in circulation for a little bit. But obviously, once you had the rails, right? I mean, we'd be talking about like the infrastructure. Once you have the rails for this, like you can create like, quickly spin up a stimulus CBDC, right? That's valid for the next month or year or whatever, to really get that money to circulate through the economy. But it is a fascinating thing. We're not really talking about it yet as far as like, influencing this velocity of money. Central banks are more focused on the old ways of like thinking about like the price of money through interest rates. But I imagine that as they start to see what's possible with programmable money, that this could become a real, another form of monetary policy transmission.
Yeah, I mean, personally, what we mapped out some time ago when this topic of CBDCs first emerged is we laid out some design ideas, and we thought it would be a good idea to look at this in like 4 buckets: at the creation level, at the storage level, at the moving level, and at the governance level. And then simply by starting to create some data, i.e., why is this money being created as a starting point, and then who is storing it for how long, what the cost should be for that, so that you actually have real-time data for that money that you're issuing as it's moving, right? I think that's a very important step that we should introduce regardless of how we're going to move forward, regardless whether or not it's a digital bearer instrument. I think it's very important that we have that data in real time, right? So, well, before we move to the privacy panel led by Jeff, any other thoughts on competition between private and public issued currencies, John? Or do you see this as kind of a shut and closed case anyway?
Yeah, I think the idea of the synthetic CBDC is kind of that gateway to that perfect partnership, but there's no one's going to go there, I don't think.
Okay, so that would mean that, yeah, I have to actually take the CBDC and then I create my own stable coin and it's backed by a CBDC.
Yeah, I mean, you can see the tension in the U.S. on this, because there have some state chartered banks have applied for special purpose banking licenses and so on, that basically you run a narrow bank and issue CBDC, and they've all been either pushed away or put on hold while the Fed thinks about it. It's got very cold feet about narrow banking. It's kind of as an aside, it's kind of funny because I think the administration is pushing for the ideal stablecoin regulation, would insist that stablecoins be issued by banks. On the other hand, the Fed is standing in the way of actually doing that, because that a stablecoin issuing bank would be a narrow bank by definition.
Yeah.
Yeah, I
David?
think like here in terms of like the public versus private, it's certainly a toss-up. I just don't have enough data points to figure out which way this may even go, or even if the Fed really will do a CBDC. Like the Biden executive order specifically said that the solution could be a combination of public and private solutions. From what I heard from the guys that I speak to at the Fed board, they were saying the Fed is not going to innovate this. Like this should actually be private. But of course, that was in the context of them saying we're not going to operate. And then if you look at the guys from the Fed Boston collaborating with MIT, yeah, they actually do have the resources and the innovation capabilities to potentially come up with something on their own, as David was alluding to. So in short, at least from my perspective, I don't know which way this is going to go. But to a certain extent, I mean, this being the US, it's very unlikely that the Fed is going to try to squash innovation in the private sector. So there should be either a happy medium that hopefully is not essentially choosing winners.
David, any final words on public and private?
No, like I say, I'm still trying to figure it out myself. I find it interesting that it's probably a moving boundary, and I welcome the innovation that can come from the private sector on it.
And then to both of you, David and John, so is the ITU, the International Telecom Union, working in any shape or form with any of the central banks?
There have been
good question.
No, there have been contributions.
I mean, yeah,
central banks. Yes,
but
yes.
Mostly not, right? I think.
Yeah. John, go ahead.
Go ahead. I was going to say, I mean, I've been involved in it for now something like 3 years, and I just stumbled into it. I don't think it's not well known. And I was at the IMF and Googling around, as I often do, looking for some innovative ideas, and I run into a paper by this mystery group at the ITU. So, I'm a pushy kind of guy, so I just pushed around and got myself in the door and went to one of their meetings in Zurich, and I was hooked. But I don't think many people even know that this working group exists.
Right.
So I look around now our meetings, and I don't see a lot of central banks there.
Yeah, there've been presentations in the sessions I've attended. There've been presentations from Sweden, from Norway, from Brazil, from Uruguay. I don't recall any from the United States, at least in the sessions that I've been a part of.
Well, maybe
there's the vendors who show up, right? It's like we hear about the Eastern Caribbean Central Bank. We don't hear about it from the central bank. We hear about it from BIT, for example.
Right.
Yeah. Well, maybe in between the three of us and also Zeke, we can create some mind melts there. I would be very interested in doing that. And then I'm very interested in your taxonomy project, because I'm doing one myself right now that we could potentially contribute to, but that's mostly on the intersection of technology and law, because we see a lot of these clients that and our otherwise solutions that projects that we are looking at are building that simply don't have fundamental understanding of legal technologies. And ultimately, that's what we're talking about here, right? We're talking about legal technologies. And that's a very important concept, and which takes us to the next important topic of privacy. Please stay if you want. If that bores you, you can jump off, and then I'll ask Jeff to be the moderator for that, because that is his daily bread and butter. And I can certainly speak to that. And anybody else?
Hey, Chris.
Privacy oriented. I think. Do you think Mrs. Faber can join us, or does she?
Yeah, Chris, we've actually got two people to join, but they're participants right now, and I need to have you promote them. I don't have the power to promote.
Okay.
So it's Gilbert Hill and Deborah Farber. They're currently attendees.
I just clicked on allow to talk. So Gilbert, let us know if you can talk now.
I think you actually, I don't know if you do allow to talk or promote to a panelist.
Yeah, because you could probably hear me right now, but not see me.
But you can't turn on your camera, unfortunately. Okay.
No, because you didn't promote me. I think you just gave me a microphone.
Oh, okay. Let me see here how I fix that. Well, we can get started while I try to figure out those technicalities here. So
It's okay.
You're partially here.
I'll be the voice of God. I'm okay with that.
Yeah.
Okay.
I'll convey my points through expressive dance. But you won't be able to see me.
I found the right blue button. So Deborah, you should be able now. And then same goes for Gilbert. You should be able to join now. So maybe we'll do a quick round of introduction because there's probably a few people that don't know you guys, starting with Deborah. Hey, Gilbert.
Hey.
Oh, there's the guitars again.
They're still there.
Deborah, you need to unmute yourself now. So, and then.
Okay.
Yeah, why don't
I said it never gets old to see Gilbert's guitars.
Yes.
Hi, I'm Deborah Farber. I am the CEO and privacy and ethical tech advisor at Principled LLC. I've been a privacy expert and operational program an operator, I guess, within large businesses and startups for over 16 years. So for me, I'm not a CBDC expert, but I'm a privacy expert coming to Web3 technologies, having done a 6-month stint at Hedera, that is a DLT that is, enterprise or built for enterprise, and have written some thought leadership for them. And so through that experience, I'm learning more and more about all the Web3 technologies. I have had stints at like Visa on public policy, dealing with lots of cybercrime. I've had, a really varied career that I think is great for this conversation. But like David in the last panel, I don't have fully formed, full on, this is how I think things should be kind of perspectives yet. And so I'm definitely open to kind of helping steer the conversation and opining, but I'm learning as well, so.
Gilbert, you want to tell us a little bit about you?
Well, I'm with Deborah, but I was really relieved and impressed by David Mangini admitting that he's still trying to figure it out himself, because I think I'm very much in that camp as well. And I'm a privacy technologist, which a few years ago wasn't a thing. And from a background in finance and digital marketing, I got into privacy kind of by mistake around 7 years ago with the advent of the EU cookie laws. So I was running a London digital agency. We were doing a lot of things with data on behalf of clients for destinations which aren't destinations anymore, like MSN. And we ended up pivoting that business, agency business, into one of the first PrivTech software products, which now is produces for cookie banners that plague around 80% of European sites, and was acquired by OneTrust, which became, the first privacy tech unicorn. So we've seen a big influx of sort of VC interest. I got into crypto similarly by mistake around 2 years back, when I accepted the offer to become CEO of a VC-funded startup using the blockchain to help people exercise data rights. And I think every time I've made this leap, I've had that situation, huge imposter syndrome, and it's forced me to actually revisit my concept of privacy and renew my curiosity in it. And CBDCs have done the same thing. And I think the more regular dialogue that us folk in PrivTech or privacy or legal technology, as you say, Chris, can have with communities around crypto or central banks around, CBDCs, and the more fit for purpose solutions, kind of global solutions that we're talking about can be. So that's me.
Yeah, and Jeff, do you want to tell people who you are real quick?
Sure. Jeff Jokish. I'm the CEO and data privacy researcher at Privacy Plan, a privacy consultancy. My background is tech and search engines, cognitive computing, before I got into data privacy. And now I do a lot of work sort of at the intersection of data privacy and data itself, creating a lot of data sets and doing a lot of research in that realm. And one of the big data sets I'm working on now is actually privacy tech vendors. And so I've done a lot of research on privacy enhancing tech and DeFi and, frankly, a lot of blockchain. And I talk with Christian quite often about these kinds of issues, including CBDCs, though I'm far from an expert on CBDCs themselves.
Yeah.
So that's where I am.
Yeah, so Jeff and I do this weekly open mic or townhouse discussion every Friday at noon PST. We call it Your Rights, Your Bites. If you ever want to join, we usually invite one very educated speaker on a particular niche within that space. But yeah, to me, where I'm coming from is I think the two most important, both urgent and pressing topics of our times are the topic of government issued fiat currencies in a digital form, in a new digital form, and the topic of what people call digital identity. And because, in my opinion, to summarize this dramatically, is if we don't get these right, then all of us that are listening to this will live in a version of 1984 that George Orwell could have never imagined. And unfortunately, there are some governments actively working towards this scenario, and we that, by we I mean people that live under more libertarian democracies, might inadvertently create the same if we don't pay attention. And so that is my biggest concern, and that's why I spent my time aggregating intelligent people like Deborah, Jeff, Daniel, and Gilbert in this particular case, talking about this and trying to create awareness for that. And then on the VC side, we're trying to find technology solutions that serve the topic of what I call human agency, right? And so maybe Gilbert, you can start by pointing out, like, how does what you do on a daily basis intersect with new currencies, and then B, can facilitate privacy preserving tech in that context?
Yeah, and I mean, I think it's really important you zoom out, and I'd like to a bit later to focus on that bigger picture and the kind of a dark side of programmable currencies. But I mean, in terms of a day-to-day, and I think I've already hinted at this, and I know Deborah and I have chatted about this before, is that I think we tend to think about, applying crypto tech and strategies to privacy rather than the other way around. And, for me personally, as I mentioned, it was applying blockchain to kind of glaring privacy problems that provided the first real life use cases for this kind of technology that I, as a privacy as a privacy wonk, as we say in the UK, could relate to. And, here's one example. We got a situation post GDPR where people's data rights need to be protected by the companies which hold the data. And I think with this debate, a lot of the importance is with the language that's being used and who owns that language. So the language that's being used around, data controllers, that essentially a companies company's holding the data, and then data subjects, which is you and me. And the state has had a role of sort of independent arbiter or referee at a time where organizations like the IAB, the Trade Association for say programmatic advertising, have been seen to be playing both sides. Currently a challenge with the oversight by the central government is that all these data controllers, all these companies are marking their own homework so they're keeping a record of a number of, say, data subject access requests received, and they're also keeping the tally stick in terms of how they were resolved, and the majority of them are like resolved satisfactorily. Just like with those cookie banners, the infamous Max Schrems of the Facebook lawsuit. His new focus is to his own agenda, has said that 90% of people are, and forgive me, it says I've got an unstable internet connection, saying that 90% of people click on these banners, but given the choice of the sample they asked, only 3% would actually give their consent if they had a free choice. So you've got this kind of broken system already with data, and the regulator's only control on this has been to monitor the volume of complaints from the public. So we've got this technology running ahead, the size of the LUMAscape doubling practically every year, and all of this, the safety valves of this have been managed by what I call like a postal process. So emails, centralized database with all kind of attendant risk of breach. So for me, the first step, was like treating requests, these data requests, as microtransactions on the blockchain, in our case, the Stellar blockchain, and storing not personal data, but the requests and responses themselves, was providing us a kind of a new tally stick or a central statement of record. And that provided a real insight to the volume and state of health around how such requests are handled. And obviously you mentioned ID. So from a user side, sending proof of ID attached to emails in this context can be replaced by things like tokenized ID proofs, and repatriated data can be kept safe in a crypto secured wallet. So world, all of the kind of different food groups for a solution around data are present and largely unregulated. If properly regulated and applied correctly in the case of data, and obviously we can extrapolate out to currencies as well, there's no need for the user to be aware of exactly what's going on, under the hood, just like, the best tech in my smartphone. And, I think, just to finish summing up, the background, less often talked about is the fact that privacy can help crypto and not just the other way around. So ironically, some of the most widely used Web3 tech, like the MetaMask wallet, which is roaring ahead at the moment, it picks up loads of personally identifiable data, and it puts it, pretty much puts it out there. But as someone who's kind of been active in the Web3 space, and I advise now, both conventional businesses and crypto projects on privacy, I've found that most of the crypto community, particularly techies, have the same set of beliefs around personal data that Deborah, Jeff, I, and others have in privacy tech, and they're very receptive to approaches such as privacy by design. I was actually at a conference last Friday where they were talking about, ethics by design, and equity by design. So it's a concept that's evolving all the time. And, we're seeing the same eagerness from founders. I'm an advisor to a new VC fund called Blueverse, which specializes in the metaverse, which is another kind of risk vector for, personal data. And what I'm seeing the same, eagerness from founders to avoid the kind of privacy pitfalls of Web 2 and, embrace ethics in these kind of new digital worlds. So it's far removed from central bank digital currencies, but I think the background and the willingness is there to explore these, and I'm really enjoying seeing how that's bleeding into the commercial sphere, and as I've been hearing so far, into the central banking sphere as well.
Well, in my mind, is a very competitive advantage, actually, if you design a solution like that. And what I personally would want to see is basically an analog to what we have in terms of phone numbers, where I get a do not call list on all my data. And that's probably somewhat naive to expect, but again, I'll keep pushing on that. Deborah, what have you seen in that regards? Do you see a lot of companies that you're advising going in that direction, or they're just more concerned of shielding themselves rather than actually protecting their clients? Because that's
it's a great question, because for me, coming from last company I worked for full time was Amazon. So coming from a perceived violator of privacy in some areas, and having to deal with the political fallout and all that, I would say that it's a lot of corporate America, a lot of the Web 2 FANG companies that, are pushing against standards that they think are going to require a lot of money to change all the technical debt that they've amassed over the last 20 years, just from moving fast and breaking thing kind of mentality, and just continuing to build and build and build forward without actually looking back at all of the potential privacy holes you have in your infrastructure. And that takes a lot of money to fix. So for me, and I know Gilbert feels this way, I'm sure Jeff, you do as well. And Dan, I don't really know you yet, but what I'm seeing, working with the rise of privacy tech, Gilbert's also an advisor, with all of the companies that are startups that are being founded now, some of them Web3 companies, some of them not, they're led by mostly technologists, not privacy experts, but technologists who maybe saw one major problem. Maybe it's in the ad space, maybe it's in the healthcare space, maybe, and they want to, the market's changed now. It's not just, laws that companies are trying to skirt around. It's the market's demanding more privacy. And this is where we're seeing, Google make concessions and say, oh, okay, we're going to, get rid of our third party advertising program. We're going to, make everything zero party. So the world is changing just as Web3 is also emerging. So all the Web3 companies that I've met with, it's such a breath of fresh air. It's how can I embed privacy into my architecture? It's, hey, come to the table, be our advisor, and walk us through how to do this right. And so for me, I've never been so enthused about the future of privacy. Honestly, in the work that I'm doing, I know that I'm seeing years ahead for compared to what many consumers might see, because I see what's in development now that's pushing against some of the challenges we've had. And the holes in privacy and security that we've had. So I'm never been so excited. I've never been so enthused about my profession. What's interesting is people who are new to privacy. I do think there's a lot of misunderstanding of what it means. It's a nebulous word. People apply it to some things and not others. Are we talking Fourth Amendment rights from government, against search and seizure? Are we talking about ad surveillance? It could run the gamut, or, the federal government knowing how we're spending our cash. So for me, I think that the problem I see about discussing privacy in this space is that too much of the discussion is that privacy is equal to anonymity. And if you don't have anonymity, you don't have privacy. And quite honestly, that's none of the work that I've done in my career. The privacy work I've done is, how do you have someone show up as themselves or as whatever identity that they, come up with? And then how do you have defaults that are the most private that then you allow them to share as they desire with whomever they want, whether that's disclosing this is my identity or disclosing this is a nuanced fact about me, whatever it is, right? So it's all about privacy's always been about context. It's always been about, who has access to data. And these discussions are not being had when we're saying, oh no, if we don't have complete anonymity, you don't get the nuance, right? So I agree that cash is an edge case. For me, it's an edge case for anonymity where you want it to be anonymous by default.
Yeah,
but I think that's an edge
for most
case.
People, privacy is just on an exciting term, right? It's like people's eyes glean over and they have clicked a button a million times at this point in time that says, yeah, I'm going to agree with your privacy policy. And obviously no one ever reads that. And it's really not about privacy, right? It's really about human agency. It's about self-determination. It's the fact that there's an entity that you're engaging with that knows more about you than you know about yourself and can use that knowledge for social engineering and on behalf of the client social engineering into doing something that you wouldn't otherwise do if you had actually control agency over all your digital dust, like I like to refer to that, right? But I want to leave this discussion mostly being handled by Jeff, since I keep doing all the talking most of these discussions like I usually do, because I often talk about things like cybersecurity separately for an hour without breathing.
Same.
Oh, thanks, Chris. No, I wanted to raise one point. I think that we need to make sure we understand that privacy is different than identity. Obviously not the same things, but one thing that I've noticed, go ahead.
Not to interrupt, but they've been completely separate professions. So your identity folks and your privacy folks have not been having those conversations that you think they've been having. Okay.
They don't, right? Another sort of related thing though, there's this real dichotomy going on right now where everybody's collecting more and more data, right? Whatever kinds of data points. But you've got these privacy laws that are forcing people to remove PII, right? Try to de-identify data, to anonymize data, right? But yet at the same time, you've got these laws like the Bank Secrecy Act, right? And others, right? That are trying to make you collect identity, right? And do KYC. And so you've got some organizations that are trying to de-identify, other organizations that are trying to identify. And that's causing a huge sort of, dichotomy between what people are trying to accomplish. And how do we sort of fix that, right? Identity is right in the middle, right? So how do we figure out who you are and still give you privacy, still give you some level of privacy? And what does that privacy actually mean? So I actually posted in the chat earlier, right? When we start to embed identity into a transaction, does that mean that we're going to remove all the privacy? Or does that mean that we're going to have, anonymity between the transacting parties, but still leave the metadata there so that the intermediaries can see what's going on? Or does that mean that we, should actually have complete privacy and, let the government try to figure out what the hell's going on through other means and just leave it at that, right? There's so many different levels that we could potentially do this, right? And then to add one additional thing to that, right? Dave, I think it's Jevons said, could we do KYC with attestation and perhaps zero knowledge proofs that can enable most of the AML and sanctions compliance requirements for the BSA, right? So there's obviously privacy tech that, could potentially enable some of this as well. I really think, as Deborah does, right, that this privacy tech can sort of lift us out of this problem and solve these identity problems that we have. But figuring out that exact mix and not, excuse my language, fucking it up is what we really have to do now. And getting that right mix, the perfect mix, is really what we as privacy professionals have to figure out and help the rest of the industries figure out.
So thanks to you, I have to edit this video now and bleep you. Okay.
Sorry.
Thank you very much. Daniel, what are your thoughts?
Yeah, so I think so. I approach privacy from a different perspective. It's actually great to be with people that focus on privacy. As a profession, I see it more from the point of view, given my involvement in permission blockchain deployments and also like all the research within public blockchain. So I see it more kind of like from the network topology perspective. So what I see when just with talking with banks and other financial institutions, they always have the wrong idea of what privacy is. And really like talk about it from computer science terms, we're really talking about confidentiality, which is the ability of a system to keep data, user data private, whatever that privacy model is. So from the blockchain perspective, I like to break it down into who can see what, but not only I'm talking about the users, but also talking about like at the infrastructure level. So one thing is you have a user. So there's two things that you're hiding on a ledger or that you can choose to show on a ledger. One is the transaction, another one is the user. So those are the two main things. And there's a lot of other things you can include in it, but to me, it boils down to that. There can be additional data, et cetera, but it's really the transaction and the user. Then on top of that, you have agents that are running the infrastructure, the node operators. And then you have the agents that are running the governance of the blockchain. So when we have a CBDC, we need to be very clear when people are looking at the different platforms, what privacy are we talking about? It's not like a one-line answer. It's really like a long specification. Are the people running the network, do they have God-level access? In a scenario where you have a central bank running a CBDC, can they see everything? Can they selectively see stuff when a red flag pops up? If you have node operators, can they see the data? So, and something that never really came too much to light within the Facebook Libra project, because that project was dead on arrival, given that it was pushed by Facebook, who had like a terrible track record in terms of privacy. But when you looked at the infrastructure that at the time the Libra project was doing, which was my understanding is that it was actually based on the VMware blockchain, because they actually hired away like half of the VMware blockchain developers, was BFT type of ledger, where you have all these companies that were the ones paying like the $10 million membership fees. So from the outset as a user, you couldn't see anybody else's transaction. But if you're one of those lucky 20 or 20 node operators, you essentially could see all the transactions from all the users. So really that $10 million ticket that the users were paying was relatively cheap when you consider what, for example, a company like Target can do with that data to then like literally target what the users are doing there. So it's important to define the thing, like the governance visibility, the operators visibility, and then the actual individual user with respect to each other. And then once we have that in mind, the other thing is how is the privacy implemented within the platform? Because that actually changes a lot of things. Information blockchains, one of the main things is most platforms actually required a third party to act kind of like as the one knowing the roster of a given secure channel or a given privacy channel. In other platforms, you don't need that one. Like essentially, if you're in the channel, you know the channel exists. If you're not in it, you don't even know it exists. But in the ones where you're actually depending on a third party or a mediator, that is data leakage, privacy leakage that you should be aware of. Again, this gets very nuanced, but it's important because when we're talking about CBDC and state actors and stuff like that, these are ginormous honeypots. And that's where these are going to be under a lot of stress. And that's not even getting started on everything that here the other people on the panel are here talking about, which is related to the PI and all that other stuff, which is a whole other like Pandora's box. So I'm just seeing it kind of like from like literally like the infrastructure perspective, and that on its own is a whole book.
Could we build a CBD and make the transactions tokenized so that all the PII was tokenized, like TokenX, a privacy tech firm that is in the financial arena, just got $100 million in financing. They got some pretty good tech. It hasn't been applied to CBDCs, but could that work?
So if you do it in permission, so a key thing to keep in mind, in public blockchains, transactions are expensive because of the size. And in general, public blockchains don't have any privacy. So any decent CBDC project would actually be on a permission blockchain. The more privacy you add onto it, the bigger the cryptographic load and the cryptographic payload, which means you're going to start slowing it down.
What do you mean by the more privacy you put on it? Because that doesn't make sense to me. So I just want to understand.
Well, I guess whether it's robust or not. It's simple if you have privacy where you say, okay, like if Deborah and Jeff are in a channel, then essentially me as a mediator, when I see a message from the ledger, I send the private data only to you two. That's kind of like I call it a lazy privacy approach. The other one is where you're actually distributing onto a ledger that is fully encrypted, and then only Jeff and Deborah can go and say like, oh, I have the encrypted keys for this, so I can go and pull it in. So
okay,
now,
so more complexity of the cryptographic.
Exactly, more complexity is really the right term for that. So thanks for that. That's what I mean by it.
Okay, thanks.
Like homomorphic encryption's expensive, you mean?
Mm-hmm. Yes, exactly. And when you get into like that type of encryption, that again, it really depends what type of operation you're doing. If it's like simple adding subtraction, it may be doable. Once you get to more complex stuff, then it's going to slow down your blockchain to a crawl. And something to keep in mind is that blockchains are inherently slower, more expensive, and more complex than centralized databases.
Yeah.
So in a CBDC where you have like a very well-known trusted party in the middle, which is the central bank, you need to think hard as to why you would want to go for a blockchain and what is the benefit of using the blockchain. And don't get me wrong, there's a lot of benefits, but that needs to be a key criteria so you don't just slow down a system for no reason.
Yeah. And I'm not suggesting that we necessarily want a completely confidential CBDC or that we even want a CBDC. I'm just saying, could we do it?
And I think great points. And I think that the privacy slant that this shows on it is highly contextual and it's proportionate. So, I think a lot of the challenges around, how heavily to apply privacy are partly behind this really long gestation period for a lot of CBDCs. The Bank of England project's been like ongoing since like 2016, and there's a really helpful resource I found published by the ECB in December 2019, where they'd been sandboxing CBDCs on Corda, which is, you all know, distributed ledger platform for the financial service industry. And I dug that out, and it's really interesting how they focus on a couple of key areas with this, in terms of they were looking to how to build a simplified CBDC payment system where you'd have proportionate privacy. So you'd safeguard user privacy for, lower value transactions while still ensuring that higher value transactions are subject to mandatory, AML checks. Similarly, if you've got that situation where, the transaction validation mechanism, you've got, as Daniel said, brilliant, this, a party with a kind of a God view, intermediaries validating a CBDC transaction need to look at the information on past transactions of the units all the way back to the moment when they are first issued. That means that a bad actor or, a participant who wants to get information can build a knowledge graph based on the information collected from the CBDC units it collects, it handles over time. Now, again, the ECB talked about something that they referred to as kind of like chain snipping, resetting the history of a user's units to reduce the amount of information that an intermediary supplies to other participants. And I think that's really interesting because it reminds me of the kind of a privacy by design approaches that we take in other slightly more stodgy areas of the Web 2 economy, in terms of only taking the data you need and closing up, picking up the breadcrumbs behind us. So it does seem that, slightly more thoughtful players like the Riksbank are tackling this. And, again, that was something that was called out in the white paper from the Fed as well, that I think the earlier predictions that this won't get fixed anytime soon are absolutely right. This is probably a generational struggle to get to grips with this, but we do have some of the tools, as Deborah was saying, things like zero knowledge proofs, and they have been socialized in other contexts, and they can be used. It's still a giant step from the centralization associated with Web 2.
Yeah, so let me read the definition again of what the CBDC Fed discussion paper puts forth. So the authors define a CBDC as a digital liability of a central bank that's widely available to the general public and is analogous to a digital form of paper money. So that is very reminiscent of the original title of the Bitcoin white paper, peer-to-peer cash, right? And so there, my common wrap here is the Bitcoin white paper actually never mentions a ledger. And obviously you don't get a ledger when you hand over cash, right? So you just, by the virtue of having it and having control over it and receiving it, the transaction is settled and there's no paper trail attached to that. So I think that's a common fallacy that people conflate DLTs and blockchains. So DLTs are not blockchains. And then more importantly, there's a very refined use case of blockchain-based solutions because, and you guys know this much better than I do, you should never, ever create a quote-unquote immutable record from anything that's PII, because at that point in time, you kind of what I call invalidate the herd immunity of your application, because, now you cannot comply with any requests as quaint as they may be to be forgotten, right? So larger point there being is, and that comes back to your point earlier, Daniel, I think by and large what we should recognize is that the current topology is something that needs to be understood, as in the current network topology is such that it looks at every human being in the same way it would look at an IoT device, where it just observes the data it creates and stores it, distributes and refactors it. So in order for us, I think, and that's my thesis for you guys to peer review, in order to reverse this, is we basically need to get property rights on all your digital dust, and we have the primitives now, right? So we have we could in theory create private keys for all of our digital dust that are then controlled by whatever run out or what people call wallets right now. So that is my thesis, and they are specifically in the context of CBDCs. If we actually take the words of the Federal Reserve on their merits here and consider this as the digital form of paper money, that we should actually request and point out, yes, we can do that, right? Yeah. So that would be my demand, and that's why I'm trying to have these discussions with folks like you and saying, well, that's really the only viable way to go forward, because you're otherwise actually not able to comply with a lot of different legislation that already exists, right? end of
That's
rant.
an important point, because it's not like a lot of privacy is already defined. Like, what are the rules around data protection? I mean, we've had my whole like 16-year career. It's been this evolving body of knowledge and legislation, and like now we have GDPR that's kind of ruling, you know, a lot of the global rules around how we use data. So my point is, like, there's a lot of academia. There's a lot that we could pull from to these new sets of technologies. We don't have to recreate the wheel with where we start and how we frame this. We just need to, like, people like us need to kind of, I guess, disseminate and teach others like what, you know, how to approach privacy by design and it to be compliant with today's laws. Then we also need to care about what's coming tomorrow in terms of compliance and building to, but there's plenty of guidance today in terms of requirements.
Jeff and I hold the theory there's no database out there that doesn't have some form of data in it that it shouldn't have in there, and that given the right forensic tools, we can identify those and then invalidate those people that have custody of it and or their business model in that particular context. So all of these
modeling. Exactly.
So all of these forums, I encourage everybody to think in these terms, as in, if you can build a business model invalidating the legacy business model, that's a really good paradigm shift, because that's what that I think it's important to realize. So you mentioned like these typical labels of Web3 and Metaverse, and it's very important that in discussions that we are having, that we let go of this. I wrote my first postmortem. My Latin has become rusty. On a Metaverse project in 2001, and we have been using the term Web3 on and off since 2001 as well. So all of these labels are just that. They're very unhelpful marketing terms. It's important to realize we are still pre-Web 1.0, really, right? So you're not online when you're engaging with Google. You're not online. You're not on the World Wide Web when you're engaging with Amazon or Facebook. You're a non-player character, right? In a game called Facebook, in a game called Google. And I think that's an awareness that by and large, these terms of Web 1, 2, 3, and so forth don't disclose. And I think that's a very important point to get across. But again, strong opinions, weakly held. You are the experts on privacy. You can correct me where I'm wrong.
Oh, you're right. I think you're spot on with that. I think Meta's rebrand is a whole just, you know, like, look over here, we're doing this cool thing, right? Like, but there's so much distrust from what they've done with Web 2. You know, how do you even, like, before you trust their systems and how they design their XR, what they're calling the metaverse, right? Before that, like, how do you get people to even trust that they're going to be doing that ethically? Like, they haven't earned it. So anyway, I agree that I think there's a lot, like, Metaverse came from a dystopian novel, great novel, Snow Crash, but it is exactly what we want to avoid building. Right? We want to build something ethical. It's in the future. I think there'll be a completely different name for all of the Web 3 technologies. I totally agree.
I think you're right. There's a lot of puff around, as there always has been. But I think people need handles to grab onto. I think what I'm very optimistic about is this move towards greater individual and sub-company collective agency. So, I mean, you know, the Web 2 or Web 1.0, I love that analogy of a non-player character, and I've been using it a lot since we first talked about it. I heard it from you, Chris. Is that, on platforms like Facebook, we're passive. All our data is captured. It's monetized centrally. We don't know what's going on, even if we click the banners. So actually, zero knowledge proof and the first, practical applications of those, with privacy coins like, Monero and Dash, they do things which appeal to the more active agent. They're generating stealth or burner addresses, and that's part of the reason there's been such vitriolic backlash from parts of the press about them being, and central banks as well, saying that their hacker ransoms are all paid in Monero, or more topical uses of it in terms of the terrible conflict in Europe at the moment. But these coins and actually these technologies, privacy preserving technologies, which can be sort of socialized, are, have a shady rep. But at the same time, some of these techs and this technology and these tactics have bled into the mainstream tech space. So if you start to see, Apple's iOS 15 update made a big feature of burner email addresses to their email privacy offering. All of this stuff, that's my recurring point. It gets socialized. Well, it gets created in 90s sci-fi novels, and it starts to get socialized, and it's being explored actively by these companies that do want to get a sniff of the cool new tech. And I agree completely with Deborah's point as well, that perception, good old-fashioned PR perception of you and your brand is fundamental. So the Libra project had a lot that it did right. It had a fantastic team, it had solid tech. Their crucial mistake was they launched it in the San Francisco Mint. They made the direct analogy saying 100 years ago, they made real dollars here. Now we're going to make digital dollars. That's the thing we need to take them. As Web 2 exits its imperial phase, there needs to be a more kind of humble approach to how we can use it, and a move for empowering the individual with agency, which hasn't happened despite GDPR. And maybe the root to that is collective. I was at a conference last Friday, and all the brands and their agencies, as well as myself, were talking in the context of data monetization about the concept of data unions. That's in the context of trusted intermediaries to sort of bargain for your data rights collectively, because people aren't equipped to doing that on their own, let alone start to navigate some of the other things we talked about. And and when you start to extend that to value, that could also potentially be applied in this context, rather than exchanging one central intermediary, Facebook, for another one, albeit more trusted, the state, which is what's sketched out in a lot of these scenarios, either explicitly or implicitly.
Yeah, maybe we'll let Stephen introduce himself. He just joined the panel, and then I'll tell you what our bar is for investable solutions that are privacy protecting. You need to unmute yourself, Stephen.
There we go. It's a little different in the big group like that. Hi, thanks for having me. I'm Stephen Hollingshead, CEO of ChangeNext, which is a RegTech utility aiming to automate the compliance process that is the biggest obstacle to financial inclusion. So we use biometrics for the first property right, which is identity, an audit trail, eventually hashed down to blockchain, and big data to try and incorporate the bottom billion. So that's our focus. So this is an interesting topic that kind of overlaps with what we're trying to do.
Yeah, what I like about your profile is you speak to property rights. We just had a long discussion about exactly that. We think everybody should have property rights to all of their digital data, right? As a starting point.
Yeah, actually, our tagline is property rights for everyone. There's all this talk. In fact, central banks of the world have this organization, AFI, that purports to create financial inclusion and everything else. But the reality is that the post-September 11th, particularly, even before that, but particularly post-September 11th regulatory mindset is really about financial exclusion.
Right.
And not about inclusion.
Yeah, and also I think from the legacy players, there's always the idea, well, financial inclusion means banking the unbanked, and we think the exact opposite is correct, right? Specifically in the context, and now I come to like what the hurdle is here for us for what is investable. We look at this from the perspective, can an individual who is living under an authoritarian government safely use your technology? Or is he endangering him or herself by using your technology, by exposing his or her transactions to the government, and can then be targeted? So not in the context that we are all being targeted by Facebook, Google, Amazon, and whatnot with advertising, but these people are being targeted to be disappeared. And so we actively provide technical guidance to non-government organizations that advise their constituents on how to use technology and what technologies not to use. So larger point there being, that's our bar. If someone living under an authoritarian government cannot safely use their technology, then as far as I'm concerned, no one should be using that technology at all.
I think that's a really hard bar to meet. I'm just being honest, since it just would require like a global kind of a governmental agreement, so to speak, on some like sort of world governance structure. I just don't know if we could get the world to kind of agree on that, or even just two sides, the Republicans and Democrats in just the US. I like it in theory. Can we get to it in practice is what I'm curious about. I don't have.
Yeah, I mean, we're sticking with our analogy here that the Fed provided, right? If it's an analogous to cash in the physical world, well, I can get rid of cash real quick and no one will ever know that I have it. I'll just set it on fire. I'm done with it. And the government is not the wiser. So I think in that same terms about digital values, any digital values, doesn't matter what they're denominated in. I mean, after all, whatever it's denominated in, it's mostly user interface function, because overall we're just talking about bytes, which is the default medium of exchange anyway, if you think about that, right?
We just have so much other tech out there too that like we don't apply that level of standard to. So it's just kind of even hard. I'm just saying it's hard for me to even adjust in that term of thinking, because I'm always thinking about the threats and how do we have compensating controls? How do we prevent the threat? How do we address it internally? Like all of those things always happen. There's always threats. So I wonder if it's a little utopian of an outcome, or if we can achieve it.
Yeah, so Stephen is also active in the crossover between blockchain and biometric technology, something that in disclosure we invested in the past. But maybe you want to tell us about that intersection and there specifically how it's privacy preserving, because that has been one of our focal points for some time.
Well, I think privacy should be understood in the larger context. I mean, privacy is an aspect of identity. Identity is the first property right. So I'll kind of go through my view of property rights. I think there are actually three property rights, and only three. And all the economists talk about this all the time, property rights, or politicians talk about property rights, but they don't say what they are. And to me, they're nested one on top of the other, and they proceed from each other. The very first one is identity, who you are, and privacy is an aspect of you having consent over how that identity is used. But without identity, there is no title, which is the second property right. We have very formal processes for titles to cars and to houses and things, right? In the courthouse, right? But title is who owns this, right? Well, if you don't know who, you don't know who owns it. And then ultimately, those two rights make possible the third right, which is exchange, or commerce, if you will, right? But free exchange, I can't morally give you something in exchange for something else unless we consent and unless I know it really is yours, and so forth. So there's a presumption with paper money, for example, that you really own it and you didn't steal that from somebody else. But in the neat thing about these new technologies is that they make more perfect an old idea, which is, what built these beautiful cities that we're in and these great economies and everything else. It's the courthouse. You can prove who owns something and you can make progress. You can stand on the shoulders of what went on before and you can develop things. And it's all about creating those property rights, create incentives for people to produce. And the problem with policies that create incentives for people that don't, anyway, so it's like that. So biometrics, the neat thing about biometrics is that it does a better job. And I would say, just comment is like, we don't want to compare what we're offering to some kind of perfect world that may one day exist, or right? The only question is this better than what we have now, or any available options that we could go to right now? And so the use of my concern, because my work started in, post-ISIS reconstruction in Iraq and trying to understand how it is that you could help people in these really tough spots to have the dignity of earning their daily bread. And the point is, if you don't have property rights, I mean, why, if you're in one of these unstable places and you can't count on that whatever effort you put forward is something that you're going to be able to capture for yourself or for your family, because someone else can just pop you over the head and take it from you, then, you know, people don't do things. And so you don't have economies, you don't have progress. So it's all about using the new technology to create these nested property rights in the cloud, if you will, and you can project them across borders and so forth. So the way it works in our system is your digital identity is something that you create in a digital passport, if you will, that is associated, that can be associated with a biometric, right? So that we can prove who did what, where, when. So transactions are then, you know, you have wallets to which you have presumptive title, right? And then you can then therefore make exchanges. I think that, you know, the big thing about this paper from the Fed, and you just have to, it's nowhere near as bad as it could be. I think that's the thing you have to say, first of all, and you have to kind of put up with the government, the Washington hubris, right, of the, you know, the Fed saying, well, we want to reach out to all stakeholders. Well, you know, in the, got my copy of the Constitution right here, you know, in Article 1, Section 8, it says that the Congress is the one who regulates the coinage clause, right? That regulates the value of money and so forth. So the Fed has absolutely no business running off on its own and deciding, you know, they say, oh, it would be nice if we got an authorizing law to do this in the paper. That's ridiculous. They have no business doing so without an authorizing law. It's up to the Congress of the United States under our Constitution to do that. That said, it is something that the Congress could do if it wanted to. And I do think the other good thing to say about it is that they talk about only intermediated coin, because it would be an absolute disaster for the federal government to come in and try to replace retail banking by offering accounts directly. And I think, you know, but when we get to the risk question, it seems to be like, well, these are the same guys who lost you know, millions of security clearance, including mine and Amit Sharma's, I think probably he's on this, and other people through the OPM security breach to the communist Chinese and so forth. And you're going to trust them to provide a product this way. They're leaving aside the elephant in the room. There's one little mention like, yes, cross-border payments are made difficult by this thing and that thing and the other thing. And at the end of the list, they, oh yeah, and there's some regulatory problem. The reality is, it is that banks are scared out of all of these markets by, you know, $1 billion civil money penalty on Barclays from the Obama administration, you know, for missing a SAR in Somalia or whatever it was. And they're scared out of going into these markets. And that hurts a lot of people. And when I started talking about this 5 years ago, you know, in Washington and New York, people were like, well, maybe that's right. But if I go to central bank governors in Africa, they're finishing my sentence. They understood. They saw how their liquidity dried up and so on and so forth. This is a regulatory problem. It's not fundamentally a technological problem. There are all kinds of interesting technological things that are out there that people are innovating and so forth. But what is lagging behind is an understanding that the whole post 9/11, you know, regulatory construct that moved for a time, the Office of Enforcement, out of Treasury and into Homeland Security, 1,800 guns and badges and all that, and pushed huge liability, changed the Bank Secrecy Act, pushed huge liability onto the banks, had a cascading effect throughout the system, and throw through ice water on the innovative processes of digital finance, and keep 1 billion people with a smartphone in their pocket out of the global finance system. And that is not good for, you know, and you say, you know, you read Juan Zarate's book, right? He's like, well, you got to break some eggs if you want to make an omelet. And I'm sure he's a well-meaning guy, but the reality is those 1 billion people who are disenfranchised by that regulatory, you know, that's a huge cost. And is it worth it? And if you look at the actual numbers, money laundering as a percentage of global income has continued to rise. And so it's like, and I know their argument is, well, it would have gone up even more if we hadn't had all of these things that you know, that exclude all of these people from the global financial system. So, but I want to say that there is a way, you know, forward here, and it is, you know, if you think about the examples of private utilities, and that's what we're trying to be, and if you think about examples like Underwriters Laboratories or, American Institute of Bakers or even FINRA, where the private sector comes up with a set of standards and so forth that ultimately government accepts, but is higher than government regulation. So, in the food business, American Institute of Bakers standards are much higher than USDA standards, for example. Well, why do people adhere to those? Well, because, they want to protect themselves, they want to protect their brands, they want to whatever. So there are private sector ways to kind of move forward and create standards for that. And that's our goal with this. And I think that the exciting thing about the new technology is that you can put those property rights, that courthouse, you can put it in a cloud, and you can give anybody who has, digital inclusion, you can give them financial inclusion. But that requires us to get, kind of help the U.S. government get out of its own way. And anyway, so
so that leads us into the next panel topic. Someone in the comments just asked, hey, I'm lost where we are. So we're now entering the financial inclusion panel. So whoever wants to join that and keen for that, please unmask yourself. And hey, there's my friend Ben. Hey, Ben, you need to unmute yourself so we can actually hear you.
All right. Hello.
Hey, Ben, do you want to say a few words who you are?
Yes.
And maybe elevate yourself so we see your chin as well. There you go.
Thank you. Am I muted? Can you hear me?
We can hear you just fine.
Oh, great. Let me get some light on me over here. All right. Sitting behind the window. Hi, Chris. Thanks for having me here. Really excited. Been listening on and off throughout the whole day, and very cool. Great discussion. Happy to contribute. There's a lot of moving parts to this on the policy front, the economic front. A lot of hazards, but also a lot of possibilities.
Yeah, Ben, you want to let people know what you do and who you are?
Oh, sure. I'm Ben Bartlett. I'm a politician. I'm on the city council in Berkeley, and I served on the California Blockchain Working Group to offer a series of recommendations for the state of California on how to embrace blockchain technology. And I focused on financial inclusion. To the exclusion of everything else practically. And I'm also experienced, I created blockchain municipal bonds. We call them micro bonds. They're coming out soon. And it's meant to embrace a similar theme of making assets, yield-bearing assets available to people of lower income status. And I'm an attorney, and I help companies and founders in the space try to achieve their dreams.
Yeah, and so we have been helping Ben with his efforts if and when we can. I mean, to piggyback on what Stephen said earlier, and I think you brought up this courthouse example. I think there's a lot of enthusiasm around technologists by creating more and more units of accounts, NFTs and whatnot. But I think by and large, it's lost that there's kind of a binary choice, as in, if I want to buy a CryptoKitty, I can send you a Bitcoin, I can do everything in a smart contract system. However, if I expect a real world cat to arrive at my doorsteps and it doesn't show up, I need the nation state enforcement mechanisms with their particular evidence tools, because I can't show up with my blockchain entry at a court of law and tell them that Amit didn't send me my cat, I want my Bitcoin back, or my cat, either or. It just doesn't work. So all the value in that space, and so now we're getting to property rights and inclusion, are to be had on what I call this on and offboarding mechanisms. And in that sense, where they don't exist, we almost expect those to kind of leapfrog what we have, as in, a sub-Saharan goat herder didn't get a rotary phone first, he got a smartphone. So someone in that situation might get an NFT that represents a land registry before we will ever see that in the developed nations. Right, Amit, how do you think about this?
Get off mute here. Yeah, no, absolutely. I think that it's worth reminding and reinforcing a couple really important comments that Stephen made earlier. And I think that we need to flip the ethos of AML compliance and KYC from one that is built inherently on exclusionary practice. The current traditional finance AML KYC process, including how it treats identity management and security from an illicit finance controls perspective is inherently exclusionary. It boxes your risk, period. We need to change the ethos on it. We don't even test AML compliance against how much more inclusion it begets. And that is counterproductive to the entire argument of broader financial inclusion. And so we need to be testing AML compliance and its efficacy against how much more inclusion versus how much more de-risking. If we kick everyone out of the banking system, voila, you have an awesome compliance system, right? But not an inclusionary system. And so the ethos needs to change. The second piece is to your point a little bit more specifically, is that there are advents of the underlying technology, whether or not we actually apply them in the context of CBDCs or privately issued stable coins or digitization and tokenization to leverage the immutability of ledgers, the decentralization of access to enable access, right to someone's pocket, to their mobile or digital device. And the tokenization of value can then be tied inherently to the KYC verification process. And now those tools exist. So two things need to happen in that context. And for fear of kind of getting slightly off topic, because we're on CBDCs, is regardless of the system we are trying to support, the AML compliance elements will remain paramount to regulators that rightly want to ensure that financial services are not exploited by bad people and that there's access. Okay, great. That's nice in theory, but without modernization, including in legislation, in regulatory policy, enabling digital identity credentials in the context of financial services enablement, that gets right to your very point, which is the property right. So I should be able to own the very aspects that comprise my own identity. I should be able to permission that identity to the verifiers that need to then provide me services, whether it's healthcare, education, financial services, or government services that are critical, right? And with that digitization and the backing of the appropriate regulatory and legislative bodies, we now have the ability to tokenize value, not just for economics, but also for information. And that process, that technology exists today. We need regulation and legislation to catch up with it. That's where we have, capability through the responses of this paper and the like. And then we need to demonstrate real, actual value in that context. And, just by way of quick background summary. So like I said earlier, we're a hybrid fintech, regtech platform. So we're always looking at ecosystem of partners that can build core capabilities within that so that financial services of any type can then be interoperable with a common denominator or language of utility with respect to digital identity that services AML compliance. And the AML compliance should not be the tick the box exercise that it currently is, and really be an enabling factor. And that's where we are today.
Yeah, so then the question, I'll maybe be directing this to Ben, is how do you handle people that are undocumented, right? So we have a large undocumented population in California specifically. So they can't pass any type of screening, right? So they're living in a cash-based society. How much do you see that, Ben? And like, how do you think about, like, if anything, that can be addressed?
Right. That's a great point. And, I definitely want to double support for Amit's comments. This is an identity play, right? Everything is bearing down to identity and letting the identity be a very natural, intuitive process to engage the marketplace, services, et cetera. And so, when you speak about the undocumented people, right? So these are people who are working somehow, right? Doing something off books, and then they are either have a cribbed social security number to do something with it, or they don't have one, but they still either keep cash and then wire it, or they have it in some other kind of fashion. So I think when the fact that they're wiring it, so that point of entrance into wiring money, I think that's a vantage point where we can capture them and get them to hold their money and let it grow their money. But I think the overall, the processes we use are outdated and do not work for the present time or the future. I mean, there are 4 million Ukrainians on the road now. And we know that with global warming and everything else, more and more people on the move. They're saying in the next 40 years, a significant chunk of the world will be without fresh water. So you can anticipate the migration towards cities and from south to north just dramatically increasing. So the whole concept of how we're viewing, citizenship, and it should be decoupled from a nation state, and it should be financial citizenship, so that we can harness these people's energies into a bigger, a larger economy.
Yeah, it almost feels like we're going backwards, right? So we just unbanked a huge source of the world's population and kind of launched a nuclear financial attack on them. I think that's exactly the wrong thing to do, personally. I think we should actually support anybody who wants to be part of that global community, want to be part of a global network as much as possible. If it comes down to information or if it comes down to value, we need to integrate people, not exclude them in any shape or form. I mean, there's bad government actors. There will always be bad government actors, but we need to individually identify those. Right? Governments are functions of societies, right? They're not the society itself, and that's an important thing, I think, that we fail to recognize when we use these big labels. Stephen, you look like you want to say something.
I do. I want to pick up on if you're talking about, we've unbanked so many people. The de-risking crisis, what some regulators call an overcompliance crisis. I hear a lot in this world, the crypto world, people saying, "Well, why would we want to, bank the unbanked? Let's unbank the banked." And I think the answer, Ben put his finger on the answer, which is that people don't appreciate banks are not payment service providers. That's not a core function of banking. And yes, it's ripe for disruption. It is being disrupted, and that's awesome. That's great. Prices are going way down. Banks have two fundamental functions in the economy, and it's missing. And you go to the parts of the world that I work in, Middle East, Africa, Latin America, you go to these places and you see that what's missing is banking. Banking's two functions are the aggregation of capital, giving people an incentive to put money aside for a rainy day, and then managing that money in investments, building things that are too big for ordinary investments, not like a pizza store, but like a school, a freeway, a sewage treatment plant. This is the function of banking in economic development, and it's largely missing because the incentives aren't there. There's a lot of talk about microfinance, but really, it's micro savings programs that are the ones that are actually really, really effective. And so again, it's give, Hernando de Soto's bell jar is great, except I think of the bell jar as a positive thing. You don't want to break the bell jar, do away with the bell jar. You want to provide those same property rights to everyone, every human person. And that's in all of our interests, because you want to incorporate them into a system where we all have incentives to work for the common good, to work for value, to build these cities, to build this economy. But they need to share in that. And when you have a system that says, well, you can't share in that, we're too afraid of you, you might be a terrorist, hey, I hate ISIS, I've been there, done that. Boko Haram, you name it. These are bad people. But of the billion people with a smartphone and no access to global financial services, not 0.1% are bad actors. And yet we're excluding them from a system. And, we need entrepreneurs to be curing cancer and so on and so forth. Genius knows no borders, and we're wasting the talents of all of those people who aren't incorporated in this global network of commerce and innovation. So anyway, we desperately need to be able to use this technology to extend these property rights to everyone. And I'll make this. I alluded earlier to the fact, and there's clear evidence that this draconian system of pushing all this liability onto financial institutions is not working. It is not making money laundering grow less. And I'll put this in an Africa context, right? There's two Africas. There's Francophone Africa and Anglophone Africa. In Francophone Africa, nothing is permitted unless it's explicitly, allowed. But in Anglophone Africa, everything's permitted, the common law, right? Everything's permitted unless it's explicitly forbidden. We need to have a common law approach to this, right? Where you punish people after they do something bad. We have a Napoleonic code approach to the financial system now, where I used to be a regulator, it's like, well, you got to keep you have to make a rule against that before any bad people do it. And the reality is that doesn't actually work as well, because you can never, bad people are always going to come up with something to do. but it disenfranchises all these other people who should be innovating and producing and so on and so forth. So we need to go back to the common law approach. Yes, have good records. I mean, this is fundamentally what a blockchain is for. It's a ledger that you can trust because it's there. It's far more expensive to make a lie in the blockchain than you can get the value from the lie. So create audit trails. This is what I mean by a courthouse in the cloud. It's like Internet of Things, automatic record keeping, where I can go back and unwind and prove who did what, where, when. And our whole economy is based on this kind of proof. It's why we have loans. It's why we have all these things. If you don't have title, if you can't prove that, then you can't have it.
Yeah, I'll give you one data point, and then I'll let my friend Les introduce himself. So, in terms of G7 countries, the United States ranks last in terms of unbanked. More than 5% of the US households are still unbanked as of today, according to the FDIC. So we rank dead last there. Les, do you want to tell people what you're about?
And that's true, even though 80% of that 5% have the documents necessary. So,
Right.
So it's about a
They don't
fifth.
trust banks. Yeah.
Right, exactly. They don't like the draconian,
Exactly.
the rules that they have to follow to do it.
Yeah. Les.
Thank you. So I'm the banker on the call, 36 years, from teller to bank president, worked for Lehman securitization, worked for the FDIC consultant. I've been advising international banks for quite some time after retiring from Union Bank after 26 years. And I'm come from the liability side of institutions, primarily, even though I was a lender and all that kind of stuff. I managed a $26 billion deposit portfolio for MFG Union Bank. And so I built the AML, BSAL programs, the KYC programs, the interactions for stress tests for institutions, all that stuff. So when they put inclusion for the unbanked into this scenario, or individuals from the Fed, I was shocked. It's not their call. Their members are financial institutions and corporations. They serve a purpose. But from a regulatory standpoint, is an institution being regulated on this issue, or even about inclusiveness to the unbanked? Bank institutions have been dealing with this for a long time because of the pressure of Congress. This is what the creation of credit unions a long time ago, as well as now I want to make the post office available for banking for the unbanked. Okay. So it's always kicked around, it's always mentioned, but there's no good solution because the unbanked has several issues against any form of money settlement, no matter what it is, and that's trust. Their own legality of being a citizen or not, that issue was brought up. The check cashing companies and the Western Union have taken advantage of this to charge exorbitant fees to hit them. There has not been a good solution by anyone for this, and I don't even think the Fed even throwing this in there is a good point. I'm arguing this point very hard because banks are either development banks in other countries. I'm in Asia. I deal with 6 banks over there. There are business banks, business line banks, and there's retail banks over there. But the thing is they deal with their issues differently than we do. In the United States, for the Fed to come out with this, I'm repeating myself my third time, is that they are throwing everything against the wall. And to have this in there out of their charter is ridiculous. I'll call it that way. But I just wanted to throw my 2 cents in as the banker that had to deal with all this stuff. I've seen every kind of issue with AML, defalcation, the unbanked. We opened branches in Compton area to try to deal with this. It was a failure on the retail side of the bank, even though I was on the commercial side. So like I said, it's a non-starter for me to even talk about this from the Fed for even bringing it up.
Very good perspective. See, that's why I like to have a diverse group of people on these type of calls. I don't think we have this interdisciplinary discourse a whole lot, right? I think we need to have this a whole lot more, where technologists talk to practitioners and to legal experts. And if you ever want to facilitate that, I'm always game for these type of discussions. So Ben, can you give us an update on where Calcoin is? Is that still like a thought? Is that still operational? And maybe tell people that haven't heard me describe it earlier, what the effort was about specifically.
Oh, sure. And real quick, I just wanted to harken back to what we've been discussing. The future looks like people around the world contributing with their money to invest in large scale capital projects, because the planet's going to have to undergo Titanic scale development to meet the future. So that's water infrastructure around the world, greening the deserts, right? Food production going up 15-fold. That's going to be massive, massive investment that's going to have to come from the global crowd. And the technology with identity is the way to do it. And so I think governments will catch up with moving from the Napoleonic Code to a common law code when they see the benefits of these resources coming to bear. So I encourage the private sector to drive forward with this, and government will catch up. So case in point, CalCoin was my creation. I coined it, if you will. On the blockchain working group, we devised a state coin to be a portal for benefits distribution, and also wealth capture and asset creation. We envisioned this mechanism to do a wallet for benefits distribution to be more streamlined, less prone to expense from third parties, less prone to fraud. We know that the fraud was immense this last go round, but also the next element, getting towards wealth building because of the programmable nature of it, right? So the other panels talked about this, driving the assets to be invested in certain ways or spent in certain ways to uplift the person holding the coin. And also to capture the myriad workers throughout the state who are unbanked, to serve as a receptacle for their savings as well, and be deployed, and even facilitate cross-border remittances, because we know that that's a massive issue for this population. So it was very well received. A certain national bank looked at doing it, and they were unable to make it work with their in-house legal counsel. But their charter would allow them to, and they wanted to, because you see these banks are issuing these debit cards to offer benefits, and so they talked about transition this way and then capture more benefits, right, by having unbanking come inside, and more fees and all things you can do when you have someone with an account, right? So and then at the state level, I know that the various recommendations, including CalCoin, are undergoing a review process at the state level. However, the government is extraordinarily slow, and this new technology business is very difficult for legacy policymakers and regulators. So I think that the pressure is on for advocates who want to see this sort of change. That's as we said, a digital mechanism for benefits distribution, while at the same time protecting privacy and protecting freedom of choice and free will. Having that happen, I think that the onus is on advocates to find private sector partners who could do the pilot, and they would have to have the business connections to actually get a piece of the government distributions business. So it would be a heavy bank, or if there's a new program. So the state has all these small business guarantee programs that are coming out now, post-COVID and post-budget surplus in California, to the tune of billions of dollars. So maybe one of those people running one of these programs could partner with the local network of community banks to issue a CalCoin. So that's what I'm in conversations now with people to try to make that happen, because I do think this needs to happen, and we can deliver it.
Yeah, I mean, and I think the United States itself is in the best position because of state rights, because inherently as a state, you have the right to issue these type of licenses, right? I think that there's very few countries around the world where that's the case. So we could actually create an example in California, or maybe in a smaller state, to make these things happen, because it comes back to our earlier discussion. Ultimately, it's attached to identity, right? So the actual benefits will always have to be able to go back to an individual that we can identify as the correct recipient. And that requires us to issue more intelligent things than plastic cards. Right? That every time I look at that in my wallet, I think that this is a really dumb technology that we still have. That why is that the case when all I see on a daily basis is like super advanced technology that's like 5 years ahead of what everybody else thinks is even possible. But yeah, so Amit, so how do you see the future of unbanked, either in the United States or more globally? What's your focus? It's like, do you even pay attention to the unbanked in the United States, or are you more concerned with people in other countries? And is that the low-hanging fruit for your business?
Well, it has to be both. And I forget who said it earlier. I mean, in the United States, I think you pointed out the statistic. In the United States, you've got 7 to 9% that are unbanked, another 20+% that are underbanked. And I would argue that there's greater upwards of 50%. And that's not a joke, 50% that are poorly banked. And just look at the statistics, right? There is greater than 50% of the US population, arguably the richest country in the world, that cannot deal with the unintended expense of $400 or more. That is an economic security problem that translates directly to our national security. And so for all of the quote unquote hawks out there talking about illicit finance, if you really want to get ahead of our national security elements, we will be over investing in the development aspects of bringing in financial inclusion, because the overinvestment in punitive solutions of creating an enforcement centric AML KYC approach has led to greater debanking than it has greater inclusion. And that has had an incredible detrimental impact on our national security and our collective international security. Why is that important? In an increasingly intermediary, less peer-to-peer financial services environment, that means that global finance is not local and not jurisdictionally bound. And that means that when regulation is jurisdictionally bound and you're working in a peer-to-peer environment globally, as Ben rightly pointed out, if a massive portion of the California population depends on the flow of remittance flow, whether it's immigrants earning in dollars and trying to take it back, whether it's sending value to parents, friends, family, small businesses, in LATAM broadly, that is a massive outflow of value that is, quite frankly, in many countries around the world, is literally 30+% of their GDP, right? And then the third piece of it too is, and I can't stress this enough, we often look back at sort of the individual pieces, but small businesses, the 99% of all registered businesses in the United States alone are small businesses. That is so small, medium enterprise and micro enterprise in the global economy is the engine of job growth. That is economic resilience. So if an entrepreneur in Kenya cannot find a small dollar loan because they fit the mold of being completely categorically at risk, Africa, Kenya, God forbid, in crypto, that's the trifecta of any bank that's looking at a compliance officer and an audit saying, why would I bank them, right? And that is literally the engine of international job growth. So this has to be a global solution. And the final piece I would just say, hats off to Ben. I will do whatever we can to help you all out. This is also a revenue generative, opportunity. When you can create tokenized value in communities that represent value that can stay in those communities, that's huge. And so, instead of swiping a card that all of a sudden you have to pay an interchange for a company that's outside your state, you can actually have a CalCoin that keeps money in state. And so it's not just a public benefits and a social service piece, it's a complete lubricant for value creation. And that starts ultimately at the identity side. So what's exciting, to just loop it back into the very thematic here, is CBDCs or not, is that when we think about either central authorities or privately issued tokens of value, the issue is interoperability, identity management, and access. And if those pieces can be really the new formation of how we look at financial crimes enforcement and enablement, that's what we need to do. And as a former regulator, I wish we had overinvested this way, because a lot of the problems we're facing today, quite frankly, we created. So this is not a technology problem anymore. This is truly a policy problem.
Yeah, to piggyback on that, and that's a question for Les specifically, and the question I've actually never asked, is there like a hard cutoff that banks implement where they say, if an individual that walks into my bank has a FICO score lower than X, then we won't create an account for them? Or is it more complex than that?
No, it's not. When you open a checking account, they have a database they tie to for bad checks. If they've been with another bank and they've written bad checks, that's all they have on that to open an account. They just need to have proper ID, okay, government issued ID. That's the issue. That's why most of the unbanked are going to the grocery stores. We used to bank 80% of all of the Mexican American grocery stores in California. and we provided the cash, and they cashed the checks. They were all AML approved, all that kind of stuff. What a nightmare. I see the issue is like on high interest rate loans to individuals that are in Southern California. They passed a law that it can't be over a certain interest rate. Half the companies went away. I think they capped it out at 35%. So with check cashing and wires and all this stuff, if they would lower the fee, at least it makes it reasonable for the unbanked to continue their mode, because it's a generational issue. They don't know any different. I hate to say it that way. This is how they want to do it. They hate taxes. They don't want to get involved with the bank because it might involve taxes or deportation. So there's other influences generationally. Their children changing much dramatically here. And I see this over in Asia too, because Asia is being built on phones, not on wires. So everything is on their phone, and in primarily China, but in the other countries, they're going to get there eventually to have more phone usage. But here, it's just in a bank, it's simply, it's all ID based, but on a business side, it's not your FICO score, it's your business plans, your financials, and all that kind of stuff. And microfinancing is a very important thing, because that's the bread and butter of America and the bread and butter of the world, and that's where jobs are. And without jobs, you can't get anything done. So the focus really needs to be a solution for that part of it, because those are the people that are holding the countries together, because that's who's creating the jobs.
Yeah, couldn't agree more. And I also think the most important thing that we need to create is an alternative to the FICO system, right? And something that's globally and portable, and that is not necessarily attached to a fiat issued credential. Right?
No,
so
I agree. I think FICO is outdated.
Right.
If you go get an auto loan, credit card, these are the things for your mortgage, those are the things that are in there, and it's preset in there, and it made banking easy. Just look at the score. I hate to say it, proof of income, but it like I said, it's interest rate driven for how high or low that score is. So you're going to pay a penalty.
Yeah. So the last half hour, the last 20 minutes before I do kind of a little closing statement is dedicated to open forum and questions that are on everybody's mind. I have my own particular pet peeves that I would always like peer review on. So everybody who wants to join the final panel right now, please just turn on your camera and microphone, and then I'll put out some thoughts here for your discernment and rebuttal. Guys, I know that you're out there, so join me, or otherwise we can all move on to lunch. But yeah, so one of the main issues that I have consistently, and that's no difference with this particular Fed paper that was kind of core of our discussion today, is that I see a conflation of what people call money and currency, and I'll explain what I mean by that too. To me, as far as the definition of money is concerned, money is simply an agreement between two or more people. If you and I, let's agree that Pokemons are money between our transactions, then Pokemons are money, or we might just out of convenience default to a local issued fiat currency, and then we pick our unit of account and or medium of exchange in that particular context. But I see this mostly as an externality of indoctrination and convenience rather than an actually active choice, right? And so the difference between currencies as money is simply that currencies are simply the standardization of these kinds of agreements. Every printed US dollar note is an IOU that is denominated in 1, 2, 5, 10, 20, 50, 100 units of US dollars. That is an IOU. But it's currency, and it can be money if you and I decide that it's money between our transactions. But chances are, if some nomad finds it in the sub-Saharan desert and there's a roll of $100 notes, his utility will be in kindling his fire rather than doing anything else with that and recognizing it as money. So a larger point there being is, so in the Fed paper, I see that as a usual conflation and or they're they are still reciting what I consider to be originally wrong, which is Javon's definition of money as unit of account, medium of exchange, and a store of value. I think that is only a very narrow definition of commodity money specifically, which has never really been, as far as I'm concerned, a relevant medium to mitigate economic activity at scale. That has always been ledgers. So end of sermon. So that was mostly meant, again, for peer review. That's my statement. I think a lot of the inconsistencies that I seem to observe in the Fed's reporting and discussion is that conflation, is not acknowledging that there is a difference between what is money and what is currency, which also then goes back to their evaluation of what people keep calling cryptocurrencies, right? Because they make the statement in the paper that cryptocurrencies have money-like qualities. Well, anything has money-like qualities if we decide that it is money. So you don't know that unless you actually ask the parties. Any thoughts on that? Am I totally off my rocker, Les?
No, I agree with you that the difference between money and currency are left and right. Okay. Even like in Mexico, the president of Mexico was discussing about cryptocurrency, he called it bartering.
Right.
They both believe it's value, okay, and they're exchanging value. So money and currencies are two different things. And if it's the United States where people are still cash based in a lot of places, movie studios still pull out cash from the bank and pay people to this day. So like I said, knowing the difference is very important.
Yeah, and so do you think the Fed might do this on purpose? Obviously, I'm asking you to mind read here, but that seems to be a consistent theme that they are quoting this, what I would consider originally wrong definition.
They're absolutely wrong.
Okay.
There's no doubt about it. I mean,
I was looking for dissenting voices. I'll try to always make better mistakes tomorrow, but I guess I'll keep making the same mistake until someone corrects me on that. But there's a larger point with that, specifically in the context of the centrally bank issued currencies, because they're coming down on all these quote unquote alternative currencies and trying to put broad labels on them, right? But if you just make very simple example, the Fed or any regulator for that matter doesn't know why someone would buy Ethereum's mining reward Ether, right? So why it's being exchanged from A to B, that could be used to fuel a dApp and run a dApp on a decentralized application on that particular smart contract system, or you pay someone with it, but without asking the participants, you actually don't know. Right. So someone could be just buying a commodity. And to me, it's very much akin of deciding that all of a sudden, because I can readily exchange 50 cents against a banana, that a banana is now money. The banana is now currency. Right. So that's how it comes across to me. I think it's not nuanced enough, and we don't even have that discussion. We kind of take it as in, OK, yeah, we call these cryptocurrencies, and by the fact of calling them currencies, we assume they are always money.
Well, currencies have three elements to it. They have country risk tied to it, they have liquidity risk tied to it, and they have exchange handling cost, tied to it. So you have components of currencies that are at risk. And so a commodity has its own issues, but the value of money is a whole different topic. And so when they're saying they're a cryptocurrency, what are the components of the risk that people have to monitor?
Okay. I mean, but the main risk seems to be always the same. The main risk is like mitigated property rights, right? As in, well, if I have money in the account, I really don't have money in the account. I have a claim against the bank, right? So which is different from the money that I have in my pocket that I can readily exchange. And we all know this typical statement of ownership, possession is like 90% of ownership, or something along that lines. And so to me, this is what we should be looking for in a CBDC or any other digital bearer instrument for that matter. So that's what I'm really keen on establishing. And then I think there's no value whatsoever in looking at any of these instruments from the perspective of whether or not they are money in generalities, but you have to really examine every transaction on their own merit.
Well, what skews this whole thing is the Fed talking about currency. Okay. It's Treasury, Congress, it's a whole different element in the United States to deal with this. Right.
Right. I think what I think they are really talking about is just legal tender in that sense, right? It's something that the state issues and that someone has to accept for very particular purposes, which to me seems like a third discussion altogether.
Yeah. Chris, we had David Kruger had his hand up, I think, to come on stage.
Yes. Oh, let me, sorry, I didn't see him here. Let me make sure I find them. I'll fix that right now. More promote to panelists. David, you can join us now. Well, anybody else who wants to join, Manuel, everybody else, then just raise your hand and I'll add you to our final chat here.
Can I ask a question about what you just said about property generally? Because we're talking about value of assets or currency or those things. We're talking about title just now, and you made a statement about how, the bank really is in possession, and possession is 9/10 of the law, which is an expression that isn't actually true, but under the law. Sure. But what I was just thinking about was something like just honestly pulling from law school here, where you kind of learn that depending on the state and how the state within the United States, right, all 50 states, it really depends on what state you're in, whether or not the bank actually owns and has title, really owns the house that you're living in, that you pay a mortgage to, or do you own the title until after the mortgage is actually paid off? And that's state dependent. And so to me, what I'm trying to get at is there more of a reason why, like we have examples all across the United States from where we have maybe possession of title, but not actual title, or we have possession of an asset, but not actual title, or we have possession of the title, but like it's being kept somewhere else until we have access. And so why is that always bad? I guess I'm not sure why that's something we should be railing against.
I think about this as optionality. Right. So you can have that option to take all your money out of your bank and put it in your closet if you wanted to. Right. So most of the time, unfortunately, you don't get these optionalities. And or if you want to engage in certain types of transactions because of legacy technology, not because of the law, but because of legacy technology, we defer this type of custody to other parties. And my contention would be, well, we have better technologies now. We can let go of these data silos and we can let go of the penalty that all of us occur. I look at this from a global perspective, as in financial services right now extract about 13.5% out of global GDP. I think we can right-size this to where it needs to be, which is around 1%. So everything that you're buying right now at the store probably includes like 2-3% of extra margin just to pay for the processing of your payment, right, in some shape or form. So it would be better to just deploy new technologies and then actually reduce those pricing. Ultimately, technology solves against scarcity, right? So that's its point. So if you still want to use a custodian, that should be your choice, but you want that optionality. That's the way I think about this. And as an investor, I think about this simply in terms of utility. What provides the better utility? If I can provide you an instrument that settles at the speed of light with instant finality, and that's what the merchant wants, and he rewards you for that by allowing you to pay a cheaper price for his goods or services, that's an optionality that we should create right now because we have the technology. It comes back to my earlier example. As far as I'm concerned, I look at the current state of where we are as the state preventing people of using voice over IP technology, and instead everybody's still being metered by the minute. From a technology perspective, I don't think there's a reason for that to still exist. But let me hand it over to David and introduce himself.
No, my question was just a real basic question, because some of the things that we've talked about today seem to be fundamentally at odds. You know, the privacy aspects, the person-to-person transaction, at least some manifestations of DeFi, and then the whole regulatory regime that seems to require banks to have access to all transactions in the case of money laundering. In particular, these type of things are tracking some kind of criminal activity. And these things seem to me to be fundamentally at odds. And going back to Les's comment about the banks being strapped with all kinds of, burdens now to be the cops, not just bankers, right? Some of these things seem to me to be that fundamentally at odds. And it's almost like we're trying to come up with a system that can please all parties. I don't think that's possible. I think there are certain, it shows up to me there are certain regulatory functions in particular that have been imposed on banks. Yeah. that for a cryptographically based financial system to be successful, that the cryptocurrency providers, not whether it's a government or not is a different issue, but they're just going to have to reject those things outright, because I don't see how you can do both of these things at once. Maybe I'm missing something.
Yeah, so there's multiple issues here. So I don't know if you were at the beginning of the call. So, but if we defer the right to create money to the state, right? So then money should be treated as a public good. So that comes with certain obligations. So from that perspective, going back in time, it's somewhat questionable that we deferred that right to private entities, i.e. commercial banks, to begin with, right? So because then also what happened in that context is we deputized private companies to spy on your personal financial transactions with all the obligations that come with that. But again, if you simply use the metaphors that the Fed already uses, then I think you can work well along those lines, i.e. if you just go to your bank and you take out cash and you use it any way you want, then the bank is out of the loop. In the same way, I think about it, digital cash, as in if and when and where I convert it to a digital bearer instrument, well, the bank is out of the loop, right? So they shouldn't have any obligation. That digital cash shouldn't be burdened with that friction. And then ultimately, from a global networks perspective, because everything I think has to be viewed from a global networks perspective, as in if I can't send it to a corner of the world because it has this friction, then I figure out something else. And right now what's absurd is in some cases, it's easier to stuff $1,000 in an envelope and I mail it to Hong Kong rather than trying to get it there using wire transfer system. So that is simply absurd if you think about this. But in terms of AML obligations, and there's other points to that, is really a lot of times what we're doing here is we are conflating a number of different things, because normally what you're doing when you're pulling from your demand deposit account, you're just doing your regular business, right? So there's no reason for 4 or 5 entities to have a complete set of your PII attached to that account-based system. So at the root cause is legacy technology, is database driven solutions. So once you solve for that, then you also need to rethink regulation. Then you need to rethink, okay, should a bank not just provide what they provide in physical space? I always make the example of in meat space, they provide you with a lockbox, right? So you can get a safety deposit box at your bank. If you want to take something out, the banker goes in there with you. He unlocks the box for you and leaves the room. You unlock it with your key and you do whatever you need to do with your valuables in there. So my personal recommendation would be that by default should be the function of a commercial bank. Provide me with a digital lockbox if and when and where I need an account-based system to do other things, establish some form of whatever FICO score or something that seems to be like a legacy model. Then I might want to include you voluntarily, but by default, all my personal transactions and private transactions are actually private and anonymous, and we're going back to where we came from. Again, I look at this as just a certain technology trajectory that we have accepted as a fact, but we are not rethinking the principles, if that makes sense.
There's no technology in a lockbox, whereas there's technology on a wallet. Because I can tell you a story. One of my customers, when I was young, came in. I said, open the box with him. He pulls it out, hits the ground, big box. I go, what the heck? There was string tied around it. It was full of gold bars. It was illegal to have gold bars. I wasn't supposed to see it.
Oh, wow.
Okay. And I'm going, because he owned a liquor store, and all his cash went to gold. have to push it back in. So, and lockbox is a big liability to financial institutions. So a wallet or a custodial service for this, if there's technology involved, they're going to get into that technology because of the current regulations, all the stuff that's tied into it, because the compliance staff will go berserk. There was more people in our compliance group than our lending group, who makes the earnings. It's just a can of worms that opens up for introducing us to financial institutions, because it is an old traditional model that is laden with regulation. And primarily now because AML, BSA, and they don't want to lose their charter. They don't want to be penalized. They don't want to be HSBC and penalized every 6 months, for something in that regard. And so, like I said, it's just, they don't know how to grapple this on the custodial side in financial institutions.
Yeah. I'm obviously oversimplifying that example, but then there are obviously also a lot more technologies available now that banks simply just don't know about it yet. Right?
No, they don't. They're behind the curve on this whole thing. So.
Yeah, and to some extent, obviously, it's a benefit to have a data silo that you control, and then you can decide what the rules on these data silos are. So that's not a technology problem. It's mostly an incumbent problem. That's the way I look at this. Jeff, you want to say something, I think?
I was just going to say there's probably not a whole lot of volume of money laundering going on through lock boxes, right? But I bet you if you opened up all those locked boxes in banks, you'd probably find a lot of illegal things in there, more than just the gold bars, right? I mean, if all the banks in the world had to open up their lock boxes, you'd find a lot of probably bad stuff in there, right?
You'd find cash, you'd find bearer bonds.
Yeah, right.
But
and
there's also
in jewelry. Sorry.
Yeah, it's not only banks, though. I understand that provide these type of safety security boxes.
Yeah, in Beverly Hills, they just had a big bust there on that whole thing. So
yes.
And since we don't have metrics on any of that, because it's just unknowns, right? Yeah. Like no one talks about that. And so all we're left with is like, why people think that, CBDCs, well, not CBDCs, but why people think that, cryptocurrencies are bad generally, right? I mean, it's only used for illegal things. It's like, compared to what, the current system, we don't have metrics on that.
Well, people are just simply scared of the unknown, no matter what it is. So they react, irrationally. So.
Especially when asked to change, right, or evolve.
Yes.
Yeah, I mean, all of these things, and the paper that we were examining just repeats a lot of the myths around the cryptocurrency space, like the energy myth and whatnot. All of these myths have been created by the legacy systems, have been financed by the legacy systems, and also have long been debunked. And we're still hearing them on a daily basis, right? Now it's a big topic again in Europe that they wanted to ban, quote unquote, proof of work systems, when we know that's actually the solution, not the problem to what we're facing. All right, so we are 5 minutes at the top of the hour. I hope this was useful. It was certainly useful to me. I'm gonna update my little review on that paper and hope that I get feedback from everybody who attended today in some shape or form, even if it's just towards one question. So my objective is to actually print this, put my name as private citizen on there and send it to the Fed, hoping to open up some minds and maybe where it's appropriate, make some introductions to. If you want to chip in on that and add your name to that, you're more than welcome. Again, this is a community effort. I'm trying to crowdsource this because, again, my only hope in life is to make slightly better mistakes tomorrow. And that's my attempt to do that by reaching out to as many people as I can and run my thoughts by them rather than kind of grandstanding. And sometimes I'm just simply puzzled by what is coming out of the Federal Reserve systems and of the legacy banking systems. And some of that I can justify and understand from where they're coming from. Others, I think, have just simply to do with missing discourse and that we're not engaging with them as a community that's interested to see these solutions in the world. So yeah, thanks for everybody who contributed. And if you're interested in doing this again sometime, let me know, and I'll be happy to host that, even though it's a lot more effort than I expected it to be. And thanks, Jeff, for moderating. Thanks to Mike for moderating as well. And so, yeah, I'll let everybody go on with their day at this point in time. Thanks so much.
Great conversation, Christian.
Thank you.
Take care.
Chris.
Thanks, John. Thanks, David.